Good morning and a warm welcome to all of you to the special post-budget conference on analysis of tax-related proposals brought to you by ASSOCHAM. I'm Anisha Nair Thavan. I'll be your host for the day. Just a few house calls before we truly start with the conference today. I request all of you to please put your mobile phones on silent so that we can have uninterrupted listening of our speakers today. There will be a few sessions where we'll have question and answers. I request all of you to please raise your hand, identify yourself and the speaker you're asking the question to, and then go ahead and ask your question. So let's get started with the conference today. We're running a very tight ship. So we stick to the time and just to inform everybody, our chief guest, Mr. Nitin Gupta, the chairman of Central Board of Direct Taxes, the Ministry of Finance, has been caught up in a very urgent meeting and he will not be present here physically, but he will be joining us virtually to talk to us about the tax provisions of the budget and their implications on personal taxes, on businesses and more. So in the budget this year, Finance Minister Nirmala Sitharaman finally fulfilled the long-awaited wish of a lower tax burden on the middle class by rejigging the tax slabs with no tax on income up to 7 lakhs versus 5 lakhs earlier under the new direct tax regime. The rationalization of personal income tax was long-awaited and overdue. But she just didn't stop there. This was a please all budget. She reduced the surcharge from 37% to 25% for high net worth individuals with income above 2 crore rupees, and the maximum deposit for the senior citizens savings scheme was also enhanced from 15 lakhs to about 30 lakhs. When it comes to indirect taxes, it was a mixed bag. Some of the customs duties were increased, some were reduced. There is a lot to take in today, and we will go through the entire fine print of the budget with a magnifying glass to understand the impact of the tax provisions of the budget. So, ladies and gentlemen, please join me in welcoming on stage our dignitaries for our first inaugural session. Please put your hands together and welcome on stage Mr. Rahul Garg, Chairman, National Council on Direct Taxes, ASSOCHAM, and partner, Price Waterhouse & Co. LLP. Please put your hands together and welcome Mr. Rahul Garg. I'll request Mr. Garg to please accompany our special guest, Ms. V. Rama Matthew, Member, Tax Policy, Central Board of Indirect Taxes and Customs, CBIC, to the stage. Please put your hands together and welcome both of them on stage. Please also welcome Mr. Vikas Vassal, Co-Chairman, National Council on Direct Taxes, ASSOCHAM, and National Managing Partner, Tax, Grant Thornton Bharat. Please also welcome Mr. Naveen Balodia, Partner and Leader, North, Tax and Regulatory Services, BDO, India. And please welcome Mr. Rakesh Nangia, Co-Chairman, National Council on International Taxes, ASSOCHAM, and Chairman, Nangia Anderson India Private Limited. A round of applause for all our dignitaries on stage, and a reminder that we will be joined by Mr. Nitin Gupta, the Chairman of the Central Board of Direct Taxes, the Ministry of Finance, virtually during this event. I would request Mr. Rahul Garg to please welcome Ms. V. Rama Matthew, Member, Tax Policy, Central Board of Indirect Taxes and Customs, with a small gift from our side. We are in deep gratitude, ma'am, for coming here and sharing with us your wisdom and your insights on the tax provisions of this budget. Thank you so much for coming here. A round of applause. Thank you so much, ma'am, for coming here. I would now request Mr. Rahul Garg, the Chairman, National Council on Direct Taxes, ASSOCHAM, and partner, Price Waterhouse & Co. LLP, to please lay the context for us by delivering the welcoming address. Please welcome Mr. Rahul Garg.
Good morning, friends. Thank you very much for your joining, and I'm especially wanting to extend the thanks on behalf of ASSOCHAM and all of you to ma'am joining us today under a very, very tight schedule for the day, physically and personally. I would just say that each one of us have heard about the budget from various quarters. Two things for direct taxes stand out. One, you notice that the tax rates are not increased, but the tax collections are increasing. So what is there? And that's the trend you'll see continuing, that without increasing the tax rate, our tax GDP ratio is targeted to increase. And that means that more and more provisions making the enforcement effective and making the reporting voluntary and honest are going to be there. So this is a policy shift, not to tinker with the tax rate, but look at the tax administration and tax enforcement, encouraging the voluntary compliance as a trend is apparent here. And you would notice, and Naveen would bring you a few examples that how it was achieved in this year's budget. The second thing which is very, very apparent, that the ease of doing business agenda is not yet over, and I don't think it would be over soon. And each one of us have seen that with the faceless assessment, or with the faceless appeals, with the scrutiny and audits in the GST coming up, more and more information businesses are required to share with the regulator. And in sharing that information, there is a lot of overlap that we all find. It is in that regard, there was an announcement to create a repository of information. And what would that mean then? And I'm requesting ma'am here, present here from CBIC as a member, and the CBDT also to work together to see if the repository, a digital repository for information sought from the taxpayers and businesses, can be kept in a manner that the taxpayer once submits the information, which may be used by any regulator by dipping into it. And that will make a very significant change in the way the taxpayers get to interact with the regulators. And also it would make very easy for the regulators to dip into the information available, of course, with the consent of the taxpayers. So I think these two things, one, the tax GDP ratio is a targeted strategy without increasing the tax rate, and you can all imagine this leads to only one conclusion, that as businesses we need to follow more and more responsible tax behavior. If I were to just convert into one word, is responsible tax behavior is expected. And the second point, that in terms of the information gathering system to create ease of doing business, I would request each one of you, if you have any thoughts, this is still in making, please do submit it to SHM, and we will take it to both CBIC and CBDT to say that if the information gathering system can be used in certain manner by industry, by sector, to make it easier for businesses. I have session now inviting Vikas Vassal to walk you through quickly with few misses in budget, and then Naveen would take you through as to what happened on few things in budget and what's their implication. Over to you, Vikas.
Thank you, Rahul. A very good morning to each one of you, and thanks for joining us today in this SHM budget event. I think if we look at the overall scenario in terms of the global headwinds as well as the uncertainty which lies today, what we can say about this year's budget is it's a very bold budget, number one. And when we talk about the tax policy, I think certainty, clarity and predictability is a theme which has been running for the last few years' budgets. Now Rahul has asked me to cover a few key misses in the budget that I think we all were expecting, or at least that was the hope that industry had. And we had made various representations from SHM and otherwise as well. First, I think the industry was expecting that we will have a more aligned and rationalized capital gains tax regime. Over the years, the various things which have been added in terms of the various provisions, I think that has made the capital gains tax regime a little bit more complicated. We have different asset classes with different holding periods, with tantamounts to different kind of rate structures for them, and that is not aligned in terms of the current philosophy in order to provide simplicity on the tax regime. Similar classes of assets get taxed under different tax rates. I think that is something which has been a miss in this year's budget. The expectation is that maybe over a period of time, we will see a better aligned capital gains tax regime. And this is required not only from the domestic investors' perspective, but from the foreign investors' perspective as well. Because when we talk to FIs, Ps, and the investors, they tell us that your regime is quite complicated, not just in terms of the various rate structures, but also in terms of the compliance mechanisms as well. Hopefully that should get aligned over a period of time. Second thing which we think was a miss this year was in terms of, again, the simplification of the TDS regime. SOCHM had conducted one study along with us, and what we discovered in terms of our research was that we have more than 36 tax provisions on TDS and TCS today. Less than 3 to 4 sections, I repeat, less than 3 to 4 sections, both on TDS and TCS, actually contribute roughly about 80% to the TDS and TCS collections, which effectively means the balance 36 provisions are adding to the complexity. And let me remind you, the tax rates on TDS vary from 0.1% to 40%. The rates are very different from residents to non-residents, and depending on whether you have PAN or you do not have a PAN, or you have filed your tax returns or not. I think for the people on the dais, except for ma'am, it's fun, it adds to our business, but for the industry, I think this is a cause of concern. And I'm quite hopeful that as we go along, the government will take note of that and will address the situation. Third item, which I think was a miss in context of the larger scheme of affairs, especially from the macroeconomic perspective, was that industry was expecting that the 15% corporate tax rate, that regime should get extended. Two things on that. First, in terms of the new manufacturing, that should get extended by 5 years. That was the hope. And second, whether we can look at adding more industries beyond new manufacturing as well, because there's no relief to services. Even the SEIS scheme has been withdrawn. So can we look at something for the services as well? Government in its own wisdom had decided not to extend it. Maybe we will see some kind of schemes coming up later on, if not in this year's budget. So I think, to my mind, these are the three key misses in terms of capital gains, TDS, as well as not extending the 15% corporate tax regime. One appeal which I have on behalf of the chamber and the industry to the government is that if we are not planning to extend the 15% tax regime, can we look at a standardized rate or a stable rate of, say, about 20%, Rahul, okay, for all the corporates, all the businesses? That will put India in the league of most competitive tax regimes across the globe. And that is what the global investors are looking in. That will also solve a lot of unnecessary disputes and litigation which goes on, because people will say, okay, 20% tax regime is there and it's stable, we'll go ahead with that. So I think these are some of the points which we discussed, and we'll deliberate more on some of the finer nuances in the next round when we have a direct tax consultation panel over here. Thank you very much.
Please put your hands together and welcome Mr. Naveen Balodia, Partner and Leader, North Tax and Regulatory Services, BDO India.
Thank you, and good morning to all of you. So, as Vikas rightly indicated, there was a lot of expectations. We were talking about election coming in next year. We were talking about, out of COVID and things like that. So a lot of expectations. But I think one thing which came out very, very clearly from the finance minister is the confidence that she actually has on Indian economy, on Indian businesses, and what we are capable of doing. I think that's something which is very, very clear. 2 or 3 points again I would just want to bring up. Rahul talked about the digital economy and the data and things like that. I think the government is looking at very, very each and every granular details of what a business is doing, what are the issues that are there, what are the problems that are being raised by the industry, and what probably are the misuses that are being used. Okay, so I'll just give you a small, few examples. In case of, say, charities, there have been situations where multiple level of donations were being given, and it was being treated as application of money. Now, that is something which has been restricted only to 85%. Now, this is something which is, most of us actually don't even know where these provisions actually sit. But that's something which they have identified and said, okay, let's actually look at it and plug it. The other important provision is on independent valuation of stock. I think that's something which, over a period of time would have come to notice that that's something people tend to use as a possible mechanism. Now, that's getting plugged. Very, very smart move. Input tax credit on CSR related expenditure. That's something which is for the industry to do good to the social sector, to the community at large, that getting restrained. So the granular details of each and every provision for that matter is being looked into. At the same time, some of the problems that are being faced by the industry, by the businesses, are being addressed. So when you talk about the tax credit mismatch, like income in 1 year, a TDS being done in the second year, and there was an issue of not getting it credited, those are things which at least there's some provision which has been made. Of course, it still has to go to the assessing officer, they still have to make an application, but at least that's something which is being heard by the government. So that's something which is important. The other important element that I wanted to bring up was that they have tried to bring in clarity in some of the provisions. So 194R have been discussed for the last entire year along with those circulars coming in. Very, there were a few points which are still unanswered, but at least the point on cash, whether cash would actually fall or partly cash, partly kind sort of a situation would fall under 194R or not, is something which has been addressed, at least clarified. So we at least have a certainty to it as we move forward. So that's the second part of it. The third part which I just wanted to bring up was, as far as the individual taxation is concerned, very smartly, after the speech, a lot of us felt very good about it. Exempt income, 7 lakh rupees, very, very nice. Surcharge coming down, very good again. But again, each of us will actually have to see at the details of it before we actually say, okay, everything is perfectly all right, and it's something which is good for all of us as individuals. Even restraining the 54, the capital gain deduction to 10 crore rupees, and the taxing of insurance of more than 5 lakh rupees, having a premium of more than 5 lakh rupees. So those are things which are, again, making sure that, if there's a high strata, they actually pay more. If it's a lower strata, at least, they can get away with. So I think these are the broad 3 points that I wanted to bring up. Overall, if I were to just look at it, I would say a smart sort of a move which made everyone feel good. Not too much of tinkering with the corporate tax rates as was expected, but at the same time, the focus is clear that we would actually move away from rebates, we would move away from deductions, we would move away from complex tax regime to probably a more simple regime. So that's the overall focus. I think we have sessions in the second half also where we talk about some of the budget provisions, both direct as indirect tax. So thank you very much.
Most certainly, it's going to be an action-packed day with very interesting sessions coming up. Now, I would like to welcome and invite Ms. V. Rama Matthew, Member, Tax Policy, Central Board of Indirect Taxes and Customs, CBIC, to please address the gathering. Please put your hands together and welcome Ms. Matthew.
Good morning, everybody. Thank you all. And I was very pleased to hear all the speakers so far talk only about direct taxes. The solitary exception being Mr. Vasai talking about ITC again on CSR, which is essentially, I think, direct tax related, which has been stretched to the indirect side. So it means that you're really not concerned too much with what the indirect tax has said. Members on the dais.
Just tell you, ma'am, that the kitty that you get of the direct taxes and indirect taxes is almost same. So we pay
Yeah, we see that in the macro figures. So when I first joined service, it used to be like indirect taxes doing around 60 to 70, around 70% of the tax kitty. Direct taxes doing 28, 30, badi mushkil se 35. And then suddenly it popped sometime in the mid-90s. It's an indicator of the growth in the economy, the shift in the economy. That it's a mature economy which goes towards the direct tax side. So to that extent, we are in a very happy place. Now, from what I'm hearing, I don't know, I'm not too sure how much detail you want to hear from me. I will give you a fairly broad picture situation, idea of what we have attempted to do in this budget in the indirect tax side. Essentially, what we have done on the GST side, the tax rates are not a part of the budget discussion. The workflow changes are very much. What we have actually looked at is from the perspective of ease of doing business. Where can we simplify our processes without loss of information or loss of the flow? And put processes in place which, without being intrusive, we can ensure compliance. If you notice over the last 3 years, what we have actually done is shifted from enforcement-based activity. The enforcement was the starting point of the activity to discover exactly where we were going wrong. And when you put processes in place so that it's not so easy to play that particular game. So your fake invoicing, I think, which was such a big news about 2.5 years back. What we have done is by rationalizing the data flow, integrating our data flows in the system itself. Make sure that one flows from the other, and you cannot do one without, go to stage 2 without completing stage 1. And if you don't do stage 2, then we go back to stage 1 and ask what happened to your stage 2. And I'm not talking in terms of forms and all that. You talk about GSTR1, GSTR3B, it gets very boring. I'm talking in conceptual terms. But what happens then, it is not so easy to run the kind of fake racket which we are talking about. We make life more difficult, make it simply put process in place so that it's not so easy to run a racket, do outright fraud. Our idea is to go towards better compliance. Somebody was saying we are looking at 80% e-invoicing, almost 85% filings, GSTR filings, which is return filings, which is quite an amazing figure. Looking at where we started. 60% used to be happy, it's a good month. 2 years back, 60% filing at the end of the month, we used to be happy. Now we look at 85 and say, okay, can we tweak this a little further? Can we do some more? It also means that to a large extent, we have made it possible for a taxpayer to file easily, simply within time, without too much of a process for himself. So it also reduces your cost of compliance, that if you do stage 1, that is your invoicing and GSTR1 filing, the rest of it is, because it is autofill, you only have to make the corrections before you file your return. You don't have to do the complete entry. You don't have to generate a full return. Makes your life simpler, makes our life simpler, because you're not sitting and comparing, having to verify entry by entry. It makes life, it's a process. We've also tried to decriminalize a lot of our activities. Unless there is an actual crime, I would say not a fraud, unless there's an actual absolute fraud paid on the exchequer or a crime, we are taking away the criminal element of it. So for non-compliance of processes, for people just being difficult and refusing to appear for summons, we don't prosecute. We have parallel provisions in the IPC. If somebody is being very difficult, we can always go to the IPC and enforce. So it's not that we have taken away our powers, But we have taken it away from our act so that we don't have to do it on a continuing basis, and you don't encourage somebody at the ground to threaten or bully a businessman by saying, I will prosecute you, I will hold you, I will make you a criminal. Once you are a criminal, you know what will happen to your business. And we know what happens to your balance sheets if that kind of activity happens. We know, or we are aware of what it does to your public valuation if this kind of thing happens. So it's been a process over the last few years where we have tried to ensure that when you move against essentially somebody who's contributing to the economy in the terms of creating jobs and value, is treated with a degree of dignity and respect, and not laid open to bullying. It doesn't mean we don't do enforcement. We continue to do enforcement. But we do ensure that it becomes becomes a much more even level playing field for the businessman when he is dealing with the department. Government is a big dad. We are aware of it. Our ability to bully is amazing. Our powers are amazing. So it's for us to exercise restraint when we use those powers. So we are ensuring that restraint becomes a part of the way we deal with industry. As far as corporate social responsibility is concerned, I know yesterday I was addressing another group of business people. It seems to have caused a lot of upset. I will simply remind you of two things. One is the corporate law, which prescribes CSR, says it cannot be something which is a part of your core business area. Two, income tax has never allowed CSR as a direction. We are merely aligning our law and bringing absolute clarity. There was already a provision which said that ITC is not available on charitable activities in Section 17 of the GST Act. We are merely making it absolutely clear and aligning it with all the other taxation laws as far as CSR is concerned. Once you understand the thought process beyond that, you will not get so worked up about it. I'm not saying you'll be happy about it. I don't expect anybody to be happy about something like this. But you have to, it's the logic of it. As far as customs is concerned, we've also, one more important thing which we have done in GST this time is for enabling people who have been, they have had tax violations, who have been asked to pay up. We are allowing compounding. We have made the compounding procedure simpler so that it's easier for you to settle the matter and move ahead with everybody move ahead with their lives. If you want to go ahead and argue it out, we always will continue arguing it out, it's not a problem. But for the people who just want to finish with the problem and move ahead, we have made it easier for you to do so. So the compounding provisions, and it is the quantum of compounding levies, which was pretty prohibitive earlier, has been made much more reasonable, so that it is easier for somebody and makes more sense for somebody to compound, close this, make the payment and close the issues and move ahead. This is as far as GST is concerned. As far as customs is concerned, specific rates you can always read. I will explain the logic. Essentially, what the approach has been: deepen the value chain, remove inversion, make sure that where raw materials are not available in India, that we enable import of raw materials. Where there is an industry in India which has a capacity, encourage that industry by tweaking the duty rate. This is the fundamental underlying logic behind all customs notifications. There might be minor variations, that those would be for very specific industries, very specific deviations, and there is always a reason for that variation. The other thing which has happened is we have taken our tariff and aligned it with modern times. There were a lot of entries in the tariff of goods which no longer are a part of international trade. There are a lot of new things which have happened which go into what is called the generic others category because there is no tariff heading. There was no tariff heading which would describe that. It created two problems. One is precision of trade data. The trade data which comes to us comes from the tariff headings. We sort it tariff heading wise. So if you want to know how a particular industry is doing, there was no way without it, if a tariff heading didn't exist. Like let's say I would say about import of cotton fiber, cotton staple fiber. India manufactures certain varieties of cotton staple fiber. India does not. India grows certain varieties. India does not grow. We couldn't even distinguish between the two varieties because we did not have specific headings. So split it into different categories. It gives better quality of trade data. It allows us to be very nuanced in our restriction or rate structures, so that if you want to encourage something which is not grown in India to come in, but make sure that the domestic sector is not affected, you're able to do it. That has been the underlying logic. We have actually done a lot of it. I think the net figure was 99, but the actual figure was around something like 153. So, but the third thing which we have done is we have unbundled the rates, the 21 rates. We had a big spread of rates over the years. Periodically, we do revise do a check. This year, we decided to sit down and look at the spread. 21 is way too many. It leads to litigation. It leads to misdeclaration. It leads to confusion. Reduce the number of rates, provide clear entries, and actually speaking, the relationship between industry and government gets better. So we have crashed it down to 13. Primary rates are 4. The rest are rates which are curated for different purposes. But still it looks that the slabs are too many. I'm sure that. So the fundamental, let me clarify. There are a total of 13 rates. The fundamental rates are essentially 4. That is, apart from nil, you have 2.5, 5, 7.5, and 10. Those are the fundamental rates. There are specific sectors where you are actively discouraging. Therefore, your rates go much higher. There are certain specific sectors where you are bound by treaties and agreements, so the rate cannot be flattened beyond a certain point, so those rates are slightly different. And there are specific sectors where where the government has taken a policy decision that this is how this particular sector is supposed to be handled, so you have it. So that increases the spread. But the fundamental rates are from 0 to 10. Yeah, I'll be winding up very shortly. So give me 5 minutes. No, if not, I'll try and finish even in less. So this is what we have done with the rate structure. And the other fundamental principle is deepening the value chain in India. So the raw materials will be taxed at a lower rate. Your parts will be taxed at input parts will be taxed at a lower rate. The finished goods will be at a higher rate, unless it is something which you really need in the country and you don't have the manufacturing capacity. If you have the manufacturing capacity in the country, and the line ministry report tells you that, confirms that to us, then you try to ensure that the domestic capacity encouragement and deepening of value chain happens. That is what we have done with in the rate structure. The third thing which we have done is, we do what is called a periodic review of exemptions that in 2021, the FMR had announced it in the budget. And there, we have conducted it, we realized that we had put in a lot of exemptions, a complete list over there, and there were a lot of exemptions which cannot be covered by that because there are treaty agreements, there are international conventions. And we've taken all that out of that, and we have done a major rate revision. rate this thing. So what used to be called the jumbo notification, that the 50 of 2017, a very substantial portion of that has been checked, and notifications which needed to continue, exemptions which needed to continue have continued, which have been needed to be taken out have been taken out. The rest, where we did not have sufficient information, we have taken extension, and we will be completing the exercise in the next year. 6 months to a year, we will be completing that exercise. The fourth thing is we have added that dispute resolution mechanism, which is to be called the settlement commission, which is a settlement commission. We have made sure that it is an active enabler, because over a period of time, it had become difficult. So we have made sure that within 9 months, the dispute resolution end-to-end has to be completed. The manpower has obviously come in over the last 4 months. So it opens an additional forum for simple dispute resolution. As far as the customs duty structure is concerned, on the customs side, this is all we need to see. If there is anything else, I would request you to ask me, because fundamentally this is what we have done. On the excise side, the rate duties, as usual, we have tweaked a little bit this way and that way. That is primarily industry related and industry specific, and there has been an ask from the industry side for that. So the most unhappy souls are the cigarette guys. I'm sorry, we can't help you. You are our pet sector. We have a social issue over there, so it is one space. We have actually aligned it with the inflationary values. We have actually not gone beyond that. So it's not such as big as it sounds. It had not been touched for a while, so we have done it. But every smoker I know has complained to me about this. I'm sorry, I can't help you there. Thank you very much.
Thank you, Rama ma'am, for talking to us about the structure of indirect taxes, the thoughts behind it, the scope of exemptions, and the dispute resolution system. I now have the honor of inviting today's chief guest, Mr. Nitin Gupta, Chairman, Central Board of Direct Taxes, CBDT, Ministry of Finance. He is joining us virtually. Please give him a round of applause. We're all eagerly awaiting to hear him. Mr. Gupta, please go ahead.
Thank you. Am I audible?
Yes, sir, we can hear you. Please go ahead.
Good morning to all the senior officers from the CBIC, Ms. Rama Mekki, on the dais, other dignitaries, Mr. Rahul Garg, Mr. Vasil, Mr. Balodia, ladies and gentlemen. It's a pleasure to be interacting with expanded the time period as well and reduced the rate for compounding. So the other part of the utilization part is compounding in the last half of the year 2022. Having said this, I will get to the new regime. The most notable and already the benefit calculates down to every section of the taxpayer. The rate which has been there in the old regime is now expanding till income of the 7 lakh, and therefore any year whose income is less than 7 lakhs is not required to pay any tax. Considering that the standard deduction of rupees 50,000 is now available for salary, because even in the proposed new regime, the effective amount would be 7,50,000 for a salaried employee, that he will not be required to pay any tax. At the higher level, the benefit depends upon the amount of deduction. One is likely to have person who wants to have higher deduction to win the smaller gain, and if taxpayer is like lesser deduction, gain will be higher, and increases right from 7 lakh or 7.5 lakh to higher levels. We have tried to figure this scheme as much as possible, because it is hassle-free. It doesn't require the taxpayer to maintain any documentation, as well as it is easier for the tax administration to administer the scheme. Our experience has been very positive in corporate sector, where deduction exemption regime has been introduced, and we expect that the response to the proposed new scheme would be fabulous and very nice. There has been some amount LRS which has been we have raised the rate of TCS from 5% to 20%, and in certain sectors, in certain types of payment, we have not touched the payments, the remittances, or the purposes of medical or education. What we have covered is the other than the two aspects, the rate we propose to be increased to 20%. Another area where what is being going on is the gaming industry, the online gaming industry, and we have attempted to carve out a separate vision of the gaming industry, considering that there was a lot of confusion, there were apprehensions how to exclude the gaming industry, how to maintain that data. So these amendments to the visions, and now TBS no threshold has been provided for the gaming. This starts at nil, but it will be on an active basis, number one,
So may I invite the queries from the floor to the chairman. He has few more minutes before he goes for the next engagement.
Sir, thank you very much for your presentation. I think it is very encouraging. Again, when we started the session, we said that the tax policy is moving towards clarity, certainty, and predictability. And I think this was the theme in this year's budget as well. Compliments to you and the entire team. Thank you very much for that. So one question on the LRS scheme in the TCS, where the TCS has been raised from 5% to 20%. And what we understand is the primary intent is to ensure that if people are incurring expenditure on foreign travel or otherwise, but they are not filing their tax returns or not paying their due taxes, we want to widen the tax net. The only suggestion from our side is that if the intent is to maintain an audit trail, sir, increasing from 5% to 20% is quite severe. Can we consider keeping it at 5% in all cases without threshold, or maybe even 1%, because you will get the complete information? So that's one request and suggestion from the chamber side.
We will see what will be done, but if I can say it is TCS who will be getting credit, the taxpayer will be getting credit of the amount, and remember the tax rate is 20%, while the person who is undertaking such travel or investment abroad will not be at a rate lesser than 20%. So probably if the taxpayer can adjust the advance tax in case the TCS is an infinite, so it's not going to affect the taxpayer in any manner whatsoever.
So there is another very constructive thing we found in the budget speech, where the finance minister said that there would be a mechanism of the digital repository of information, where the businesses can submit the information and regulators can retrieve the information. So request here was to develop a framework in consultation both with CBDT and CBIC to begin with, where the pro forma can be provided of the information expected from various classes of businesses, and that could be dipped by both the CBDT and CBIC officers, and this would make the information exchange and interaction with the department really, really constructive. And we as ASSOCHAM would be very happy to collaborate with you to develop that framework and also to help in understanding any particular industry sectors if needed. Thank you so much.
We will definitely consider it, Mr. Babu. It's a very nice suggestion, and progress in the team which government is working, and it will be a great benefit to the taxpayers across elections for both CBDT and CBIC.
Thank you very much. Sir, I don't see any other, there is one hand. Could you please ask the question?
Thank you, sir. For the first time in the budget speech, our finance minister gave the benefit to middle class and very highly advertised that the tax holiday for 87A or up to 7 lakhs rupees for the new tax regime. Now, in earlier, 5 lakh limit was for 87A for both the old scheme and the new scheme. What will the fate of the old scheme, whether it is 5 lakh or 0 or 7 lakh? Number two, if we are discouraging the old scheme completely, so are we not indirectly discouraging the saving benefit like ATC or other savings benefit, which is a backbone for the middle class, number one. Number two, very kindly, you have allowed 50,000 rupees to the standard deduction as salaried class. But when our economy is going for the self-employment and rural economy, so what is the benefit for the self-employment person? That is that 50,000. That is a disparity and discouragement. That's all. Thank you.
Sir, I'm not sure if you are able to hear that well.
Thank you, sir.
Can I answer?
Yes, please.
The first query raised by the member is about the rate
Thank you so much, sir. There is one more question, a hand raised by lady participant. If you permit 1 more minute, please.
Sir, I wanted to ask you about BEPS Pillar 2. So with EU countries moving far ahead on BEPS Pillar 2 plans, what is India's plan on that? Because we have not seen anything in this budget and everyone was expecting that there will be something.
BEPS Pillar 2, what is India's plan? So that's the question.
We are in comprehensive engagement on Pillar 2, and it is a exercise that is going on. The India's presidency, we expect that something will come out, or decisions will take place. We have maintained a status quo, and let us see how the things go.
Sir, in view of the fact that we are also participating and perhaps be part of the protocol for the global minimum tax rate protocol, when it is implemented fully, would you see that the poem should still exist, or would you see that since we are signing up to the global minimum tax protocol, therefore the poem provisions should be done away with?
We will consider your suggestion at the time of deliberations.
Thank you so much. Thank you very much, sir, for your time. I know you were hard pressed with the lineup of the things at your end. We appreciate your indulgence. One of your very dear team member who has been always part of interaction with SOCHM, Mr. Kamlesh Vashne, is here for our technical session. We would take his guidance further, and we appreciate your time today morning. Thank you very much.
Thank you so much, sir. Round of applause for our chief guest, Mr. Nitin Gupta. Thank you so much, sir, for taking the time out and sharing your thoughts with our audience here. I would now request Mr. Rakesh Nangia, Co-Chairman, National Council on International Taxes, ASSOCHAM, and Chairman, Nangia Anderson India Private Limited, to please deliver the vote of thanks.
Good morning, everyone. It's indeed my pleasure to be part of this gathering of distinguished guests. On behalf of SOCHM, I would like to wholeheartedly express my appreciation and profound gratitude to our chief guest, Mr. Nitin Gupta, Chairman, CBDT. In spite of his busy schedule, he was managed to answer queries, address us, and it's always a pleasure to hear from the chairperson, especially when the budget occasions are there. And also a special guest, Ms. V. Rama Matthew, member, Tax Policy, CBIC, and she had to leave because of a pressing engagement, which normally happens to members and chairperson post-budget. Friends, for India, if you see, 2022 was actually very special. First, it marked the 75th year of India independence, and India became the world's 5th largest economy in the world. Largest economy, 5th. And if you see the fundamentals of the Indian economy, they are indeed very sound. And as it enters the Amrit Kal, that is 25 years hence, a journey towards a centenary, India going to celebrate 100-year post-independence. And you see there's a redefinition, refocus on growth, job creation, and having a strong and stable economic environment in the country. See this budget basically, it lays the emphasis on infrastructure. Investment increasing and the capex outlay of 10 lakhs crore, though we call it 33%, and yesterday the Revenue Secretary said it has a cascading effect of 18 lakhs crore actually. If you see all the pluses and the cascading effect it comes on it. Highest ever capital outlay on railways, 2.4 lakhs crore. The railways will be redefined, the whole logistics scene the railways are heading, you'll see a complete change coming in this decade. And even roads, we heard Mr. Nitin Gadkari last evening, what a change you will see, the road scenario will also come in this decade. And there was a 50 years of interest-free loan to the state government to incentivize infrastructure, a very massive boost to the state government and on infrastructure sector. The interesting part is this budget sticks to the fiscal consolidation path and the fiscal target of 5.9%, a very fine thing between fiscal compromise and the growth was there. It has been a wonderful compromise, basically. The FM has also shown a lot of responsibility by ensuring a continuous focus on job, investing in education and skilling, pushing the green growth agenda, concessions to MSMEs and startup, and inclusive and sustainable growth. Continuing this path of digital transformation, which everyone has been talking about these days, the focus has been on technology, e-codes, digital lockers, lab growth diamonds, AI, and 5G services. I think you see technology, even this decade, what a transformation you're going to find it. And in technology, if you really see it, you find change happening on a continuous basis. Forget about a decade. It's just a continuous process. And on the tax front, where we all normally here to discuss the tax front, the government was a little conservative in my approach, refrained from rolling out a big tax relief. Much of it is rationalization on capital gain, which you mentioned, and I must to add one thing, what Vikas said it. In my opinion, we were not expecting any relief on capital gain taxes. We were only asking for the rationalization of the taxes. If you fill the form, you have a 10%, 20%, 30%, base rate tax, treaty, non-treaty, listed, non-listed. There were so many categories. We just wanted it should be made hygiene list without any compromise on the tax collection was there, which was missing about that. On the other part, the manufacturing concern exemption was lost, and I have a very interesting debate to do that. Do you know that why this was introduced? Because we were expecting China One policy, the supply lane was changed to go to India. Do we know what is a tax deficit with China? It is $100 billion. Do you know what was there last year? $85 billion. Do you know that 64% of India's deficit of trade is because of one country? That's China. 12% of China's surplus in trade is because of India. And this supply chain was to be shifted to India, and manufacturing thing was tax, was an incentive. And a manufacturing share in the GDP has gone down to 15% from close to 23, 24%. Now the objective is to go to 25%. And this could have only happened as an incentive. Which country in the world does not give incentives? Every country in the world which gives incentives to promote certain categories. So my request was always there, it should have been made a long-term statute. Rahul mentioned it, but Rahul, I must need to add one thing. It should have been brought permanently in the statute, 15% tax. The economic gain to the country is much, much more higher than tax, which I'm going to ask Mr. Varshney post-session also. Anyway, we'll be discussing all this thing as we have discuss the budget threadbare. So thank you so much, everyone, for joining this thing. We are going to discuss the budget on direct tax and indirect taxes threadbare. And we have a very strong panels today here. And thank you so much for coming on this thing. And I hope you will enjoy this session as well. Thank you very much, everyone. Thank you.
Thank you, sir. And I'd like to thank all our panelists on stage for voicing their opinions, for clarifying for the audience how they see the tax structure and what's written between the lines. Thank you all for joining us today. We now take a very short networking break, one that will be welcome. We will return around 11:30 with our panel discussion on direct taxes, the analysis of the direct tax related proposals. So please join us again, and a round of applause for all our dignitaries on stage. Thank you so much. please settle down. I'm sure you've had a good chance to catch up with all your friends. Please settle down. We have very important information sharing session coming up. You will get more opportunities to catch up with all your friends during lunch. But in the interest of time, I request all of you to please take your seats, settle down so that we can start the session. And I request you to please clear the aisles and be seated. One thing has become quite clear, that the government is actively promoting the new tax regime, which will now become the default tax regime, and all the benefits of lower tax rates only apply if you sign up for the new tax regime. This is for the direct taxes. Now, is the switch from the old to new regime hugely beneficial? Who does this benefit the most? What about all the investments that you have made years ago with a long lock-in period, mainly to save tax? We'll now start with our panel discussion on the analysis of direct tax-related proposals. I would request our session's moderator, Mr. Vikas Vassal, Co-Chairman, National Council of Direct Taxes, ASSOCHAM, and National Managing Partner, Tax Grant Thornton, to please accompany Mr. Kamlesh C. Varshney, the Joint Secretary, TPIL, CBDT, on stage. Thank you so much, and please put your hands together for Mr. Vikas Vassal and Mr. Kamlesh C. Varshney, who have joined us on stage. I would request our other speakers to also please come up on stage. Mr. Vineet Agarwal, Co-Chairman, National Council on Direct Taxes, ASSOCHAM, and Senior EVP and Group Head, Taxation, JSW Group. Please welcome Mr. Rakesh Nangia, Co-Chairman, National Council on International Taxes, ASSOCHAM, and Chairman, Nangia Anderson India Private Limited, and Mr. Amit Rana, Partner, Price Waterhouse & Co. LLP. A round of applause for all our speakers on stage. I would request Mr. Vikas Vassal to please welcome Mr. Kamlesh C. Varshney, the Joint Secretary, TPLI CBDT, for coming here and sharing with us his views and thoughts with a small gift from our side in gratitude for his presence at this occasion. I would now like to hand it over to Mr. Vikas Vassal, Co-Chairman, National Council on Direct Taxes, ASSOCHAM, and National Managing Partner, Tax Grant Thornton Bharat, to steer the session ahead. Please put your hands together for Mr. Vikas Vassal.
Thank you very much. I hope you all are enjoying the morning discussions over here. So what we thought was that we will keep the session light, have a little bit fun on the panel as well as all of you, and we will not dwell into the presentation kind of a mold, that these are the provisions which have been introduced in the budget, because I'm sure in the first 24 hours since the budget has been presented, all of you are aware about the various provisions and what changes have been brought in. So the panel format that we thought was that we will deliberate on few of the issues which are relevant to all of us as industry as well as individuals, share our perspective, and then we will request the government's perspective also. And since we have Mr. Kamlesh Varshney with us for the next 1 hour or so, we will get deep insights into the thoughts, what went into in some of the provisions which have been drafted and why they have been drafted. Sir, first of all, a complaint. I think you are reducing our work year by year. Earlier, we used to be awake whole night, going line by line through different provisions. Now you are making it simpler year by year, so that's a complaint that we have for you. But thank you very much. I think this year's budget was again very bold and progressive. And I think on the tax policy, as we alluded earlier, simplicity, clarity, certainty, that's the theme. And I think this year's budget also delivers on that. Compliments to you and the entire team for that, sir. So let's first begin with what matters to each one of us. That is the changes in the tax rates. Again, year on year, there have been a lot of expectations in terms of the deductions to be allowed, exemptions to be allowed, a lot of benefits to be provided. But clearly the intent of the tax regime has been that let's do away with the tax exemptions and deductions. they actually complicate the whole statute, add to the administrative burden for the employers, employees, as well as the tax administration, and ultimately nobody benefits. Can we move to a simpler regime? That's the reason that about 2 years back, an optional regime was introduced. There have been misses and as well as hits in that. But I think this year, a significant step has been taken to make sure that most of the individual taxpayers move to the new default regime. The tax slab rates have been rationalized, basic exemption limits have been raised, and standard deduction has also been introduced. Sir, so first question to start with you, what was the thought process in increasing from 5 to 7 lakhs? Could it have been more? In your own assessment, based on the data that you have, what is the likelihood that a large portion of the taxpayers will move in that direction? My own take is that it's just a matter of time, maybe next year or over the next few years, when we will see the old regime completely going away, okay, either voluntarily or from the statute itself, and we will have only one tax regime available with us. So, sir, what was the thought process and rationale from 5 to 7? Why not 7.5 or 10 per se?
Hello. Thank you, Vikas. First of all, thank you very much, ASSOCHAM, for giving me opportunity every now and then to share my views and to get feedback from all of you, which is so very important for policy making. That's a very, important part of the question that you have asked about personal income tax. That is the probably indirect tax. This is the main important part of the budget, and which has also generated some kind of a discussion in the media. So the thought process is very clear. This government in 2015 announced that we will move away from exemption regime and lower the tax rates. They started sunsetting various provisions of the Income Tax Act. And 2019, if you remember, in the month of September, an ordinance was brought in to introduce a concessional tax regime for corporates. And it was a big success. So far, we have more than 60% of income by corporates under the new concessional regime, and only less than 40% under old concessional regime. So that has been a big success. The thought process is clear that exemption, deduction distort economic decision making. If you introduce profit-linked incentive in one state, it will divert investment from another state to that particular state. So it distorts your free decision-making process. Same applies for individual. Now, if you have to invest, the question is, should you invest in insurance because you want to be insured, or you invest in insurance because it has ATC? Now, should you want to invest in equity, but you don't invest in equity because you have to invest in ATC. And I'm not saying you should invest in equity. Some may like to invest, some may not like to invest, depends on risk appetite of a particular person. But that's his choice. That choice gets distorted. In a free economy, that choice should not get distorted. You should have that freedom. And therefore, that 2020, this new tax regime for individual was brought. We all know that, it has not been as successful as our corporate concessional tax regime. So the effort has been, conscious effort has been made in this budget to make it attractive for people to shift to new tax regime, and also to provide relief to middle class. That is the theme of this budget. How do we provide relief to the middle class? And let me demonstrate how. So basically, if I have an income of 15.5 lakh, and I will consider somebody who is having an annual income of 15.5 lakh as a middle class. Now, 50,000 standard deduction has been introduced in the new regime this time. That means my income will become 15 lakh, and the new tax rate which have been announced would result in income tax of 1,50,000. that 1,50,000 is less than 10% of 15.5 lakh. And 15.5 lakh is almost 8 times the per capita income of India. Leave aside tax havens. Tell me which country has this kind of a taxation regime, where a person earns 8 times the per capita income of that country and pays average tax of only 10% or less than 10%. Now, this is what is something you can say that middle class has been taken care of. Now somebody will say that I was already making, deduction and all that. Let's say my income was 10 lakh, what you see in the paper, that my income was 10 lakh and, I was already making deduction, or, okay, let's take 9 lakh. And by using 4 lakh of exemption, I reduced it to 5 lakh and I was not paying any tax. Now tell me, 9 lakh is a lower middle class who has an annual income of 9 lakh. How many of those can save 4 lakh out of 9 lakh? Now that's a question you have to ask. That means what you are reading in the paper is a imagination or it's a reality. ये कल्पना है या वास्तविकता है? So do we make tax policy based on imagination or do we make tax policy based on reality? How many people earning 9 lakh rupees of income are saving 4 lakh and reducing their income to 5 lakh? So now comes to what is beneficial for you, old regime or new regime. Right now the break-even point is 2.5 lakh. What it means? It means that if I have deduction of less than 2.5 lakh, and I'm talking about, I am starting with income of 15 lakh. At income of 15 lakh, if I have deductions of more than 2.5 lakh, I will go to the old regime. If I have deduction of less than 2.5 lakh, I will go to the new regime. Out of this 2.5 lakh, 50,000 was consumed by standard deduction for salaried taxpayers because that was not there in the new regime. So virtually that break-even point was only 2 lakh. So if I have deduction of 2 lakh, more than 2 lakh, I go to the old. If I have deduction of less than 2 lakh, I go to the new. That is why you will find more people in old regime than in new regime because most of them had a deduction of more than 2 lakh. This 2 lakh has now increased to 3.75 lakh, this break-even point, almost double. And therefore, we are expecting more people to be in new tax regime than in old tax regime. For this reason, that how many people have deduction of 3.75 lakh? This is a real question. Amongst most of the people are concentrated in the basket, maybe less than 5 lakh, there are a lot of people, then 5 to 10 lakh, then 10 to 15 lakh. Very few people are, on the higher income category. We know that kind of a profile, income tax profile. So these are the people, tell me how many of them will have that kind of saving. Of course, this 3.75 lakh break-even point is for 15 lakh. If for lower income, the break-even point is lower. But still, our expectation is that not many people have that kind of a deduction available to them, and they will shift to, or they will be, by default coming to the new regime. That is why all the, what we are saying in the media, all senior officers and finance minister, that we will see more people in the new regime than in the old regime. About the question that, people are buying houses, interest and all. You buy a house when you need one, definitely. But we are giving you benefit under the new regime without you having to have interest on housing loan, without you having to have insurance policy, without you having to have money deposited in ATC instruments. Even without that, we are giving you relief under the new policy, and then you decide what you want to do with your money. That's completely your choice. You want to consume, you have a risk appetite, you invest in mutual fund or equity, you want to be a long-term risk-free investor, you invest in PPF, it's all your choice. So that is the theme of the reform that has been announced in personal income tax.
Sir, I have one question here.
Yeah.
What happened to the people like who were already paying income interest on house property under ATC? They were continuing to pay that. It becomes, they were already paying insurance for dual objective, one to secure their life and second to have a tax advantage. So one has been taken away under the new scheme. And second is if I get double burden, वो तो मुझे interest pay करना ही करना है. I can't stop it. मुझे repayment करना ही करना है. 24 ATC both have gone. In those cases, the balancing has been done. He tend to have an outer cash flow and less of taxes. Maybe he will saving little, but his outflow may be much more.
See, you can't have a policy where you say that those who have bought housing loan, I will have this policy, and only for future I will have this policy. You can't have these kind of policies. That will make it very complex to administer. So naturally, when you make a policy, that's a future-oriented policy. So now in future, when you are going to take a decision about what you want to do, whether you want to take housing loan only for your housing need, go ahead and do it. Let not the tax concession distort your decision making. That is the idea for future. What you do with the past is completely your choice. If you want to continue under old, you continue under old. That choice is there. Nobody is taking away that choice from you. So that choice is already there with you. So, government has not said that from henceforth the old scheme is dead and you have to come under the new scheme. So that is not the position.
Perfect, thank you. I think some of the very pertinent points which Mr. Varshney made was, first is change in mindset of the society per se. I think we all have been used to seeking exemptions and reductions, okay, which I may use the word dole outs from the government and then decide what we want to do. I think the government is saying that the country is transforming, the things are changing, economic conditions are very different. You make decisions independent of the tax per se. And that's the reason that I think some of the changes have been brought in. Again, one very interesting point, sir, you made that 8 times the per capita income, if a person is in the range of 15.5 lakhs, you are effectively paying a tax of 10%. I think this will augur well if we look into the purchasing power parity and compare ourselves with different jurisdictions. But definitely, there is something which more we will obviously ask for. And the third very relevant point you made was theory versus practicality. Once we read something in the press, we get very much influenced, or what transpires on the social media, we get influenced. But practically, we will have to look into in terms of what are the benefits you are availing under the old regime versus the new regime. My own take is that it's just a matter of time. Over a period of time, we will only have one regime. I think the transition has happened over the last 2 years. Now this year it will be a significant change. It's just a matter of time. Okay, moving on again on the personal taxation, sir. Thank you on behalf of Vineet, Rakesh and Amit for the high income earners. You have reduced their tax rates. Okay, I still fall in the 15.5 category, but these are the high income earners who want to thank you. So what was the thought process? It was an unexpected but very welcome change, sir. 43% becomes 39% effective tax rate. Was there a leeway available for you, sir, to reduce it even further down, maybe 35%, which becomes even more competitive? Directionally, it is very, very positive, sir. We put ourselves in line with many countries where we are saying that, okay, not only for the lower class and the middle class, but for the high income earners. And there have been certain concerns that whether we are competitive vis-a-vis jurisdictions like Dubai, Singapore and others where high net worth individuals keep migrating. The data shows about 30 to 40,000 high net worth individuals and high income earners moving year on year. So I think this is a great move. So your perspective on that from 43% to 39%, why not 37 or 35?
On the lighter note, it was decided because I thought if it gets reduced, Mr. Rakesh Nangia will throw a party and invite me. He did throw a party but did not invite me.
Sir, we will hold another party on his behalf and will invite you.
So, okay, on a serious note, basically, you are right. There are various things that one has to consider. Flight of a high net worth individual to outside India, whether that is the reason, probably not. because if you actually analyze if those high net worth individual leaving, you will find most of them leaving to actually USA. So USA has a tax rate higher than us. So probably it is something else, and we all know what are the reasons why people would like to have a green card. Definitely, there are some other advantages, not tax advantage, there are some other advantages. Yes, some people do go to tax havens also, and there the tax is the advantage. And that advantage would still remain whether you reduce that surcharge 37 to 25 and even to 15, that advantage will still remain. Tax haven are tax havens, So probably it's not, that is not the reason why it has been done. But if that is an incentive for people to stay in the country, we'll welcome it, right? So as a you can say as a corollary. Now, basically, this higher surcharge was introduced in 2019 budget, second budget of 2019, proper budget of 2019. There, at that point of time, there was a need to raise revenue, and therefore surcharge was introduced. Surcharge is for a specific purpose, raising revenue and all that. And now that that need was not felt, and it was realized that it is time that our maximum marginal rate must reduce from 42.7 to 39. See, if you remember in 2019 September when we announced corporate tax regime, concessional corporate tax regime, the purpose was to attract foreign investment, and we have got foreign investment. That is how you see higher economic activity in India in spite of gloom all over the world. So all these decisions have, helped. Tax decision, non-tax decision, whatever policy initiative government of India is taking. So that is one part. Then can we also moderate tax rates so that, when some big companies are trying to make investment into India, they have another incentive that if they have to relocate their management personnel to India, those management personnel don't have to pay higher tax rate. So that is also one of the incentive, one of the part which is important for attracting investment. So there are various reasons why this has happened. But I think it was that maximum marginal rate went up in 2019, but it was kind of a temporary measures, and now to some extent it has been reduced.
Thank you, sir. Picking up on one point which you mentioned, that surcharge is for a specific purpose, and similar is the case with cess. We are always told that it is for a limited period of time, whether surcharge or cess, to meet certain specific requirements. But sir, experience tells us they are just like uninvited guests in our house who never leave us. So is there a thought process, sir, in the government that at some point in time we should do away with surcharge and cess for two reasons, sir? It adds to the tax burden, definitely. It also complicates the whole process in terms of calculation and other things. So, sir, your perspective on that.
See, let's say education and health says that we have 4%, which you are saying that, it was introduced in 2004 and is still continuing. But then you also see that money is going to states. Maybe it is a cess collected by central government. Both education and health is a state subject. But still, government of India, through the cess collected, help state government in various education projects, in various health projects. So it is not that, it is something, if it has stayed for so many years, it is for a definite cause and good cause to promote education and health, help state government to carry out their activity in these two sectors.
Thank you, sir. We appreciate your perspective. Message is loud and clear. These uninvited guests are going to stay with us for some time. And obviously, for the larger macroeconomic reasons and social reasons, we appreciate that. Before we move to the other topic, if anybody in the audience has any specific issue or clarification required only on the budget provisions on individual taxes or personal taxes, you can raise the query with Mr. Varshney right now. He is the architect, chief architect of all these provisions, and I think any thoughts that you raise will have a bearing on this year's budget as well as in the future policy making of the thought process. But please restrict your queries not to a personal issue, but only to what has been provided in the budget. Any questions in the audience? Yes, ma'am. Please wait for the mic.
related to budget only, and it's related to personal taxation only. So your point is very valid that in future government wants to move to the new tax regime. And also we have an ATD of 50,000 for the medical expenditure of senior citizens. See, it's good to pay tax, but what are the benefits we are getting? Like, why is it only restricted to senior citizens? It can be for babies also, no? It can be for us also, for brother, sister, or anyone. So why is that restriction? I'll give you an example, short example. A person gets hospitalized and the bill meter starts like anything. It can raise to 10, 20, 30, and everybody has seen that in the last 2 years, the COVID phase, right? So why our government is not doing anything for that increased limit? And why is it restricted to only medical expenditure related to senior citizen? It's fine, you increase the tax rate, make it 10 to 15% the per capita income, but what are the facilities the individuals get? I am raising this point because I know you are the draft committee, and I want this point to be taken to the draft, or at least from next year provision.
Thank you.
So the one part of your question that, whatever tax is collected, what facilities are being provided, that is outside my scope. That is how money is to be utilized, that is the expenditure side of the budget, how money is utilized by the central government or by the state government, I won't be able to answer on that. Coming to your specific question, exactly that is the reason why new regime has been introduced. You actually made it gave the reason for new regime without deduction, because ATD, medical insurance, is under the old regime, which says 25,000 for you, 25,000 for your parents. Your question is, why only parents? Why not this? Why not brother? Why not sister? Exactly, why not? That should be your choice. So why have ATD? Instead have a lower rate and let's leave it to you. For you, your brother, sister is important. Somebody else, mother, father is important. Somebody else, mother-in-law, father-in-law is important. That is individual choice. So leave it to that.
So let me put it in perspective. I think your point is very relevant. I think what the government's thought process is, they want that decision making to be left to each individual. That's the reason more leeway is being given in terms of the overall slab rate benefit. You decide in which particular year what is more important for you and accordingly take a decision. There will never be a right or wrong answer to that, but I think these are different perspectives. And when the government also does its calculations, they have to balance it out between the revenue and the expenditure, because different stakeholders in the economy are demanding different things, but point taken. Vinit, you have one point on this.
Yeah, regarding, sir, government push to new tax regime, certainly, if you remember 90s, early 80s and 90s, Income Tax Act was supposed to be the harbinger of all changes, social, economic, industrial in India. You want to promote export, Income Tax Act. You want to promote industrialization, Income Tax Act. Particular area, hotel, whatever, even investments. So basically, it's a right thought that why should these decisions be governed by income tax per se? This should be economic decisions, personal decisions, and that's why income tax rate should be neutral. You decide on your own, perfectly, sir, that's welcome. And in fact, when this new tax regime was introduced for corporates in 2019, there were a lot of apprehensions, basically, that will the industry choose to forego all those big deductions and everything, accelerated depreciation, etc., and move to 22%. But you see, of course, 25%, but everybody has moved. And if you, sir, what 40% you are talking about are only those corporates which have brought forward loss or some ATIA deductions. And I'll tell you, sir, by 2025, everybody will shift. So this is a big success. As far as new tax regime for income tax is concerned, yeah, certainly, still we are in like those frame of mind. We have all our ongoing insurance policies are there. Certainly, few things are still left because in salary structure, you have LTA, you have HRA. Certainly, those have not been considered. So probably, in my opinion, those earning up to 8 lakhs, probably they can manage and they can bring in new tax regime immediately. For others, you require a push, something like which has happened for post. Oh, of course, I'm not below, not the super rich. Thank you for bringing me there. But certainly,
soon you will be.
I don't know. There's a top secret. Yeah. So but certainly like above 5 crore people, suddenly, I mean, it's no brainer now. You have to be in new tax regime. Okay, if something like this could have been for even those 2 crore and 1 crore also, sir, I can assure you that maybe by next year everybody would have been in this. Okay, so
he has shown that he is between 2 to 5 crore.
Sir, so, but certainly the right thing is that yes, why should income tax decide how should I make investments? Okay, but sir, there are certain nitty-gritties. I mean, I think there are a lot of memes also being made on that up to 7 lakh, no tax, and 7 lakh 1,000, you are poorer by 25,000. So sir, that adjustment is required because somebody who has earned 7 lakh 1,000 should not suffer. Yeah, so that's...
Vinit, that point will remain even if you make it 7.5. Similar issue could be there.
No, what I'm saying is basically...
Talking about marginal relief,
that
the
marginal
way we give in
marginal
surcharge.
relief, yes, sir, yeah. Because that is there in surcharge, but for this exemption, this deduction, the deduction of tax, it is not there. So probably that requires some ironing, sir.
Perfect, thanks. I think there's one more question from the audience.
Can I ask one question, please? Yeah, please. Yeah, there is one query to all the gentlemen, and obviously with this belief that you might have the potential to influence the future budgets also, that why there is not the provision for the special reductions for the women taxpayers in our country when there are now more than 50 countries in the world who are giving this special regime to the women taxpayers. Now this question is not coming from someone who is not a women feminist proponent, who is a very serious one. And we know that when we are working as a women, we expect the equality. But when we think about the women working in the different spheres of the work, undoubtedly, the contributions, the challenges, and of course the sacrifices and the opportunity cost of leaving a woman out of the family are much, much higher as compared to a male fraternity member. So why this provision should not be there? And if you people are sitting as part of the draft committee, is there any thought regarding this?
Very good question. How many of you saw that direct tax team photograph with the finance minister? Yes. So you have seen, you know, and I don't have it here. I would have, no, I have it in my mobile. I would have put it here. You know, it was a huge hit in the social media. Why? Of course, that was a more than a direct tax team because it had finance minister who is a woman and 2 MOS who are male. But let me tell you, my team, there are 8 women and 5 men. Direct tax team in CBDT has 8 women and 5 men. And this question, exactly the question which you, madam, asked, was put forward to those 8 women, and they said, we don't want any concession in income tax.
But I'm sure that those 8 women cannot be the representatives of the crores of women of our country when this can be a rightful right of the women fraternity. It is not asking for something special.
No, sure, ma'am, your point is taken.
Yes.
Your point is taken. I think.
But I'm really happy that this question has been raised somewhere on certain platforms, and tomorrow sensitization would be much higher.
No, point well taken.
Yeah,
point well
thank
taken.
you.
Ma'am, you remember, I mean, some 8 or 9 years back, there used to be a small concession for women. I mean, do you want that kind of small thing, 5,000 rupees or 10,000 rupees? No. I believe that's not the thing you are asking for. Probably you should ask for more spending towards women entrepreneurs, I mean, special schemes for women entrepreneurs, or special work facilities for female employees.
So that's exactly finance minister has.
Probably that would have been a better ask rather than a small tax concession.
Yeah,
Sorry.
that exactly finance minister has been announcing in every budget, and even in this budget, self-help group, she has been promoting. That is how you enrich, empower the women, like what our finance minister has been doing, and not through income tax concession. Of course, everybody has different views. I mean, our view is that you empower women through actual help to them to come out of their house and work, and not giving any concession in income tax.
Very well said, sir. Thank you. I will take more questions later on. In the interest of the time, I have to change tracks now. Yes, yes. Let me move to the next topic. I know this is one topic we can deliberate whole day. In fact, we can take away the time from the indirect tax session as well. But still, we will not be fully satisfied after that. Okay. Rakesh, let me move to you on the next topic, which is in context of the angel tax in terms of the startup ecosystem. New provision has been introduced to cover the non-residents to bring it at par with the residents. Okay. First of all, tell us what exactly is the provision. I think the startups are not covered, the registered startup. What exactly is the issue other than the startups? And what is the ask from the startup ecosystem to make it even better?
Okay. So I'll just make it briefly. 5627B is the section which I'm going to have a question to sir. Is earlier there's already the provision in the law when you are taking any share capital at a premium amount, at a premium, and if the money is coming more than the fair market value, and if it's a resident investor, then this amount gets taxable in the taxable. Non-resident investor were exempted from tax under 5627B. Now my question is this, first there's a dichotomy with the FEMA law. FEMA law says you need to bring money at a fair market value, not lower than that.
It has to be exact amount.
Yes, it has.
Under FEMA.
See, what is the challenge is this? If some investor comes, invest in my company at a little high market value, the recipient of the share capital, which is a capital receipt, his income gets taxable. So this is something, and the whole ecosystem of the startup, the value that it brings to the country, the value in terms of employment, GDP, valuations, unicorns, in the 100 of other advantages, is going to stop bringing money, can affect bringing in money. If such type of deterrent comes, you end up paying such a high tax is concerned. Second is, very interesting part is this, only startups which are IMB registered, this provision is not applicable. As per the information that we collected today morning, less than 1% of startups who are registered are IMB approved. So this advantage is only limited to 1% of the people. So this is the second thing. And when you do the valuation, actually, basically, share is something, FEMA law says something else, income tax law something else, my capital gets taxable. Earlier it was resident, you brought non-resident. It has a serious inflow issue also, sir. This is first my question, sir, on this. I have one or two more, but this is more important, sir.
Right. So what you have said is, that's a correct statement of fact, and we have noted it down. So we will see what best can be done. For example, like 11 UA rule is currently applicable only for resident. If we have to amend that rule, we will certainly look into this FEMA regulation, which sets the minimum floor price. And surely, we need to align ourselves with the other laws so that it does not create inconvenience.
So AC analogy, thank you so much for this. 80 IAC, when you have given the date of incorporation, has been extended from 2023 to 24. So one thing which baffles me is 1 year you give it, you're indicating is a sunset, and this is going to end. And why when you're giving a tax exemption, 3 years in 10 years time, आप इतने छोटे-छोटे period के लिए दे रहे हो sir. आप इसको थोड़ी certainty दो. Do we consider, sir, 100 of other advantages the startup bring in the whole ecosystem of the country, or tax is the only thing we are thinking about it? So give them a certainty. They're creating so much of wealth, global wealth, intellectual property, and they bring 100 of other type of revenues and taxes also, sir. Employment, TDS, so many taxes they're bringing. So एक साल की बड़ी कम period लगता है.
नहीं देखिए वो इसलिए कहा जाता है because there is a direction of the government to focus on a particular sector during a particular period. So if 80 IAC exemption is given, that startup must be incorporated by that date. That means the policy of the government is that it should be done today and not tomorrow. If you have a longer sunset date, then people would try to do it tomorrow rather than today. So it is always, that's a policy call, and it's conscious policy call. We want to do it today, and therefore a shorter period is provided. And there is another thought process, that when there is a date for sun to set, sun must set on that date. this question will become relevant. I don't know whether you have that in your agenda or not, about that new manufacturing company 15% concessional tax rate.
So we're coming, I have a serious agenda on
Okay.
that, sir.
So I can address it right now, you want later?
Serious agenda.
Okay. Yeah, okay, you can address your concern, I will address it.
Sorry,
Yeah.
I'm taking another point of manufacturing tax, very relevant. Sir, just, you brought us, I put up an industry, you give me a lower tax regime of 15%. When I put up an industry, sir, I plan it, it takes time to implement the industry, and it's a whole, it's the core of the country, sir, today. Manufacturing, a share has gone down, which I said in the morning. You want to see the supply chain gets in India. You have a competition from countries like Indonesia, Vietnam, and Bangladesh, even like this thing. Manufacturing is the core of the country. And you give me exemption for 1 year. I was always educating, and I told even to the pre-budget member, it should be permanently the statute, sir. Permanently do 15% tax. Give them an incentive. I'm not asking exemption. I'm asking a lower tax rate, and it should be the permanent, because it's worldwide, sir. If we want to bring an ecosystem of startup, and for ecosystem manufacturing, where the share has gone down from 25% to 15%, so I think this needs an extra bait, actually.
No. First of all, like your previous statement, I agreed with the facts. On this, I don't agree with the facts. I have a different narrative of the fact. This is not for 1 year. It was announced in 2019 till 2023, and which was extended to 2024. So people had enough time. So it is not that I have announced it today that sun is going to set on 2024. No, that is not the case. Time has been given. Sufficient time was given to start manufacturing, because government wants to start manufacturing today. The jobs must be created today for our youth, not tomorrow. So clear time was given, and there has to be some kind of sanctity to the date that is being announced for starting manufacturing. And your second part of your, your views, that it should be permanent. Now, that also I don't agree of that view, that it should be permanent. Because there is a distinction between 15% tax rate and 22% tax rate. If 15% has to be permanent, then 22 should be brought down to 15. Or then 15 should be escalated to 22. Then you should not have two regime. If you have two tax rate for corporates, one for service sector and one for manufacturing sector, then that concessional tax rate must be for limited period of time.
Sorry, Vikas, can I just ask some follow-ups on the startup? So, sir, on the 5627B, the point that Rakesh raised, on that, merely 11 UA and saying resident and non-residents get on the same path will not address it, sir, because even the 11 UA evaluation rule simply talks about maybe DCF you can use. But we know today companies have even, the startups have been listed also. Those valuations are not DCF. They are much higher than that. And there are handshakes that happen because these are commercial deals where private equity is putting money in at valuations which are much higher. And that is what is driving the unicorns and the decacons and all of that in the country, because their potential is what the bet is being taken on. So it may not be a projection on cash flow only. It is much higher.
So do we have that valuation methodology in FEMA?
So FEMA simply, as Vineet also mentioned, gives a floor. You can use an internationally accepted valuation, and that's a floor. And if you get higher than that, because FEMA is simply saying that I don't want Indian companies to be sold out at cheaper valuation. So it simply sets a floor. So if you get anything
but
higher.
There must be some methodology to arrive at that floor.
Yeah, so that a valuer, sir, can only use, let's say, a book value method, market multiple method, or a DCF method. These are the only things available to a valuer. Now, actual deals happen at, so I, as an investor, have a perception that, okay, India has this big growth story coming up. A founder may not be actually able to project that out in cash flow. Of course, book to kuch hai nahi, because these are all mostly service and tech companies, so there's no book value. And market multiples also, because not a lot of these are listed, you don't get market multiples. So therefore, somewhere you have to be able to bring a safe harbor or something that in a, let's say it's a third-party deal, so we will allow the valuation, because otherwise this whole valuation thing will kill this.
No. I understand. That's why I'm trying to find out, because probably solution can be found through 11 UA itself. That is why I'm saying But how it is to be done, we can have a discussion and do it. That's possible, I feel. So, I mean, we will certainly take all these points into consideration.
Okay. So just, Vikas, if I can just ask on the startup ecosystem. Right. So this year, very, very welcome in the economic survey, there was a whole section, you must have also seen it, on this whole flipping of structures. So historically, what has happened is for various reasons, whether it is for better valuations or for access to global markets, a lot of the Indian startups at the very initial phase actually flipped the structures, which means the structure was, let's say the founder invests in a Singapore or a UAE or a US company, Delaware company, which then has an Indian subsidiary. Now with the Indian, some really good examples of great valuations for startups in the Indian securities market. We've seen Zomato, etc., Paytms. So people are actually now interested to flip back. Now, and I can tell you, sir, a lot of the startup ecosystem is actually structured from overseas. And plus, of course, RBI brought in the round-tripping rules, which have also eased the entire thing. So it would, an economic survey made that suggestion, it would be really good for next year for the government to actually think about it, because, we know this big fintech which has just flipped, they paid $1 billion of tax. But that kind of affordability most companies will not have to flip the structures back to India. So that's something that...
Right. So, I mean, definitely India would like to see these startups operating from India, being headquartered in India. One also has to understand whether it is because of tax reasons. Do they need something in tax to come back to India, or something else which is required? So probably we need to study, what is that something else that is required, which needs to be addressed, and if we need to have some kind of a tax to attract them, that also needs to be studied. But yes, definitely, I mean, Government of India would definitely love to have all these startups being operated from India rather than from overseas land.
Yeah.
Sir, on this particular point, I think a couple of changes will be required under the company law, FAMA, as well as income tax. Basically, some thoughts. One is that helping these kind of startups which want to bring back the holding company structure to India, and it will be good for all of us. One is that allowing the re-domiciliation, which certain countries allow, from overseas to India. Therefore, the Companies Act will have to be changed on that. Second is in terms of allowing a free flow tax neutral merger and demerger of a foreign company and an Indian company, partially allowed, but lot needs to be done on that. I think if we can look into these two aspects from company law, FAMA, as well as income tax, it could be a game changer. Tax, you are absolutely right, is not the only reason. I think the situation has changed in the last 1 decade when everybody wanted to be in Singapore or Dubai to have a holding company structure. A, the tax rates have gone up over there as well. B, I think the investors are more comfortable now today in investing directly into India. Of course, we can debate on this point, but yes, in general, the comfort level, as Amit mentioned, has gone up. So I think it will be a good thing if we see some changes happening. It will bring in the confidence of the investors to push the startups to come back to India now. That's one point.
Sorry, just one other thing. Sorry, Vikas. Sir, on the startup thing, the other big demand, which definitely would have come to you and you would have considered, is the ESOP taxation. So today, you get taxed when the exercise happens. Now, at that point in time, most people, because there is no liquidity, okay, assume it is, there's no liquidity event where someone is buying out their shares, but tax triggers. So most people just keep sitting on it and then valuations go up and down. That is also something, sir, to be considered now. In a listed company, where there's a ready liquid market, of course, that works. But now this whole startup ecosystem where actually, exercise could happen earlier because there are limits within the company rules as well. So I don't know if that has been considered by the government, but really would appreciate if there are any thoughts.
This issue was considered and discussed in detail. So in fact, this year, I must say, this year budget exercise has been quite, strenuous, and rightly so, because each and every suggestion was discussed, some of them at length, and our discussion in the month of November and December many times crossed midnight also. But it was, all the suggestions were taken on board, discussed, and there are various considerations which have to be addressed before we select a particular suggestion for being incorporated into the finance bill. So this one was not only considered, but considered at length. And a lot of discussion took place. Decision right now is not reflected in the finance bill. But as we say, this tax reform is an ongoing exercise. If you see, Vikas also referred in the beginning that it was a quite a simple finance bill, did not take much time to read and understand it, and which is a fact. Maybe clauses are 122 clauses, you see, but 60 clauses are basically consequential amendments. So proposals are only 60 actually, if you see. So, and that was a conscious call, just to have a kind of a, not too much things into the bill this time. So a lot of proposals, if they don't find a place in finance bill, does not mean that they are not deserving one. This is an ongoing exercise. More discussion will happen. There are certain concerns. Those concerns, once they get addressed, these issues will again be examined and if found appropriate, be part of the finance bill. So yes, this issue is very much in the mind of the people who take decision.
Thank you very much, sir. Just a couple of points to sum up on this subject. One, and that's on a lighter note, sir, valuation is just a number. It's like a beauty in the eyes of the beholder. If two independent parties are deciding, there should be some flexibility which should be built in, and also in terms of the way the revenue approaches these kind of transactions, sir. Because if a third party is investing, keeping in view the future prospects of a startup, they are looking at it from a very different perspective than what we have over here. Therefore, if some flexibility is there, it is possible. Sir, we have ourselves seen that valuation of startups increase in billions of dollars over a period of 6 months or 12 months. Nothing right or wrong in that, but that's a fact, the way the business ecosystem works. So just one consideration over there. Second, sir, thanks for clarifying that ESOP point was considered. Currently in India, we tax ESOPs at the time of exercise stroke allotment of shares. For registered startups, it is extended by 5 years. Please consider if that period could be extended a little bit further, because that will provide a genuine leeway. Why I'm saying that is, an employee when he exercises actually pays out of his own pocket and gets the shares. Tomorrow if the valuation goes down or startup goes bust, that money is a dead loss for him or her. Just consider this point. Your point is also very relevant, that largely we have also seen that most countries do tax at the time of exercise stroke allotment of shares, but that's just a perspective.
Sorry, because just one, I just want to give an anecdote. Sir, and this is fascinating, you might have seen this ChatGPT, which is taking the world by storm. So very prominent tech company has put $10 billion. There is not even a commercial use case for that company today, but that kind of valuation is happening. So,
yeah, Amit, the other perspective is from the, being the moderator, I have to balance the view. I think departments also has to look into the misuse of the provision sometimes. Yeah. And that's the reason the balance out provisions are made. But point well taken, Amit. Any question on the startup from the audience, which is not a specific question, but in terms of the budget provision or otherwise, if it's an ask? Okay, great. Everybody is, sir, very happy with the startup provisions. Thank you for extending by 1 more year and extending the period of 7 years to 10 years. Vineet, before I come to you from the industry's perspective, let me go to Rakesh. Significant 2 announcements for the MSMEs. Significant announcements on MSMEs, presumptive taxation, and making sure that they get the payment made. Just elaborate on those provisions.
Now the payment made, sir, just this is only for the purpose of information. This provision has been introduced so that MSME gets paid in time. And if the payer doesn't pay him the money, he will only get the deduction once the money is paid. So if a payer doesn't pay you throughout the year, there's no disadvantage to the payer. It's only the 31st March, the year-end payment. If it doesn't make you in 45 days, the threshold, then only this amount gets not allowed as an expenditure to him. So it is a very minuscule part. Year-wise, you can still suffer. you may still have a cash problem. In terms of this provision, yes, at least there's some bait, some better cash flow. He will have a discount at least on 31st of March. So this is just for information purpose. Sir, I think I'm right in my understanding, sir. Yeah. And what is?
So your point is that if you are making a provision on 31st March and the payment gets paid in April or May within the specified period of time, whether the deduction will be allowed in the 31st
Only
March
45
financial year?
days, suppose the threshold, you pay the money, it will be allowed. But on next, not like filing return like under 43B. So it will be, then it will be allowed next year when you make the payment.
Yeah, just to clarify it, I mean, I'm not talking about the provision because I'm not too sure what happens when you make a provision for any expense, whether it is counted as accrual or not from tax point of view. I'm not that clear, so I will not, but situation has not changed. If making provision count as an expenditure, it will count as an expenditure. If making provision does not count as an expenditure, it will not count as an expenditure. But let's take a simple example. You actually accrue an expense on 31st of March. You know, that is that particular financial year. And the payment is required to be made within 30 days. What the MSME Act says, that the payment must be made within the time in the agreement, and time in the agreement cannot be more than 45 days. And time in the agreement cannot be more than 45 days, and if there is no agreement, and written agreement, not oral, and if there is no agreement, then only 15 days. So let us take, you know, the maximum can be 45. So if the payment gets made in the month of April of the next financial year, then you will get a deduction in the earlier financial year. If the payment gets made in the July of the next financial year, you will get deduction in that next financial year, not in the earlier financial year. This is what the provision is. Nothing to do with the due date of filing return.
Yes.
So if the invoice is dated on 31st March, payment made in April within the due date, you will get the deduction in the 31st March financial year.
Yes.
But if you make the payment in July or August, you get the deduction in the next financial year. That's clarity.
Yes,
Thank you
that
very
is
much.
it. Yes.
Vinit, now all the large corporates are required to pay. Generally, they have been doing it, but now it is mandated and it has to be done now. What's your perspective as a large corporate?
First of all, I'm here as industry representative. So I'm the only person. So, and when I'm talking about industry, industry does not exclude MSME. It includes.
Absolutely.
Okay. So I have to talk from the perspective of the entire industry. Some of us may have grudge, okay, because we are forced to pay, okay. But why shouldn't we? MSMEs are to be protected. I mean, if you see what has happened during the COVID time, it's not large corporates which have got hit. Large corporates continued their production, continued their business, even in the peak COVID time. And I'm vouching as a first-hand experience because our factories were running full-time. And it was those 2 years where we made bumper profits also. But everybody knows in this hall that the section in the business which has been hit is MSME. Okay? So they need to be protected, and why not? When you can protect under section 43B your financial institutions, your government bodies, why not this small chunk? And there is a tendency to perpetually defer their payments. So there certainly MSME Act is always there. And I differ with Mr. Nangia when you say that there is no problem if you continue not to pay during the year. Because even if you delay during the year also, you have to pay interest. And not only interest, all those delayed payments have to be actually reported in your report, annual reports. And that reflects very badly on your credentials. Okay, as a large corporate, that reflects very bad. And when Amit told it's all about valuations, for last 1 week we have seen what valuations mean. Okay, I mean, it's only valuation and the entire ecosystem is just shivering. Okay, so it makes a lot of difference. So yes, I fully agree that this payment should be allowed, and it's not that you are being disallowed. You're just being told, okay, whenever you pay, you get the deduction. And it gives you extra incentive. I'm not saying disincentive. It gives you extra incentive to pay in time, which is required as per law. So I fully agree.
Perfect.
I agree
so
with
there is, in general, a support from the industry. And there is, in general, it is being considered as a very positive provision. The intent has to be looked into. Of course, there could be some issues in terms of the cash flow management for the larger corporates, etc. But I think the intent is very appreciated. I think we had few hands being raised. Yes, please. I'll come to you, ma'am. Do we have a mic over here?
Thank you to the esteemed panel. So my question is, as we were discussing on the accrual part of MSME, so often what happens that the corporates do book provisions at the year end. And now, practically said and done, it may be even a proportionate portion of the services received, where it is quite often possible that the MSME has not invoiced yet, and also likely that he might not invoice yet in the next 30 days. So that's what I want to understand, that even on accrual basis, will this be considered as a disallowance?
Sir, just to clarify, what he's saying is if the provision is made, please correct me, by 31st March, MSE raises the invoice in April, okay? And the payment is done in time, whether this will be allowed in 31st March or next year when the payment is made.
See, I would believe, maybe we can look into this. My earlier, disclaimer that whether you allow expenses on provision basis or not, or whether you allow on invoice basis. Now, so I'm assuming that you allow it, then I will answer the question. Then that limit should apply. Once you have accrue an expense in your book, that means it is payable to MSME. And if it is payable to MSME, then you must pay within the time allowed under MSME Act.
I think just to...
May I add, see, the money is payable after the invoice is raised. So even if the invoice is raised after 30 days, you still get 15 days, no? So see, the Act says that it should be paid within, as per permissible under MSME Act. So it is permissible, very much permissible, no? Even if money is raised after 1 month, it is very much permissible after 15 days. So yes, with that disclaimer of sir, that yes, whether it's accrual is allowable or not, if accrual is allowable, then whenever his bill is due, if you pay it, it's allowable, simple.
Right. So it has to start from the invoice date.
Obviously, under MSME Act, that's the issue. It's not as per your accrual. It's as per the invoice. Yeah.
Perfect. Yes, ma'am.
So one question is answered, but there are various issues with MSME. We have to procure certificate every year whether the company is a part of MSME or not. So sometimes we don't get certificates in time. So when we are closing and when we send a letters to give us a certificate whether you are a part of MSME or not, and they come little later after end of year or so. So what is to be done in that case? Secondly, sometimes they don't give their invoices in time, as he said. And sometimes there is a problem in the invoices that rates charged are not, as per PO. So we have to stop the payments and we have to wait. So these kind of practical problems are always there. We, always submit returns also twice a year as per Companies Act. So I don't think that the payment should be disallowed.
So let me address this. This is beyond the realms of the budget right now, but very relevant questions. First question, I think in terms of certification, we'll have to take it up on behalf of the chamber with the MSME ministry over there, not with the income tax department. Second one is the more commercial angle to that.
So my question was whether if we don't get certificate in time and we don't disallow it.
I think practical issues, we need to address it with the different ministries, but it's not purely linked to the budget right now. But definitely, ma'am, relevant point, we should take it up as a chamber, Avinash, with the MSME ministry as well.
Certainly, because it will be, it's not a new issue basically. It has been under MSME Act also. Exactly, so that has to be addressed separately because it is not Income Tax Act actually, right?
Very relevant point, ma'am.
Yes, sir, can we make it like some online portal itself if a MSME is registered there and that PAN is linked to them? Probably that will solve the problem.
No. We will see, what to do about these practical suggestions. So those can be examined. But this is a conscious call not to allow till return filing date. That is a conscious call.
And also, I think since this provision is getting introduced now and being strengthened now, I must use these words, I think there will be some teething in issues, but as I mentioned, they are very open to receiving suggestions. Let's provide them the suggestions. I'll take the last question on this point before I move to the next topic.
Thank you, sir. what will happen if the partial payment is made to the bill and partial is due? Suppose X amount is the bill.
So I think whatever you have made the payment, you will get the deduction, balance you will not.
Number two, how a MSME can report to the department, because if the department doesn't know whether the amount is paid or not, and the company does not reflect in the balance
The
sheet.
deduction is to be disallowed for the company which has not paid to the MSME. Therefore, it's a loss for that company which is not making the payment in time.
But if the company does not report in the balance sheet,
you're saying how can
No,
MSME
audit. It will
complain?
be part of audit report also.
okay, whether it is applicable to non-corporate also, yeah, only corporate. This particular protection is from the corporate client only or for the everybody?
Everyone. This is for everyone.
Everyone.
I think one more. Yeah, please.
Yeah, just one question. So we have separate acts to deal with delayed payments for MSMEs and other provisions. And with respect to, so we already have separate provisions to deal with delayed payments to MSMEs.
Mike.
What was the rationale behind kind of coming up with the income tax provision to penalize delayed payments? So this is one. The other is more pertinent. While this is just a deferral of the deduction, but we recently had a...
Bring the mic near to you.
Yeah, so we recently had a Supreme Court judgment which disallowed delayed payments of employee share of Provident Fund, which is very harsh. So has the government looked into it, because a genuine expenditure is being disallowed just because even if it is one day delayed?
First of all, that your first part of the question has already been answered by the industry player, that what is the reason for this provision and why it should be welcome. The second part is does not relate to the budget, but I can tell you that checkmate decision that you are talking about, the government is very clear, because the money of Provident Fund or ESI that an employer is holding is in fiduciary capacity for the workers, and that must be deposited in time. So that's a reason.
Thank you, sir. I think we'll take it up
No,
offline now.
I think we will answer it offline. We will answer it offline.
Plus, I think we should look at this provision not as a restrictive provision, but as an enabling provision for the MSMEs. I think just a different perspective, and things will be all right after that. If we look at it from a different perspective. Let's change track now. One of the topics, Amit, which has been a little concern for the individuals is in terms of TCS on LRS, right? Just provide us a perspective as to what the change is from 5 to 20%. We know the reasons why it has been introduced. Just provide your perspective, then we'll ask Mr. Vashni to share his thought process on that.
Sure. So this year, the TCS provision under 206, for the liberalized remittance scheme under the exchange control laws, there are various categories in which you can make those payments. You can make those payments for medical and educational purposes for which there is no change. But for tourism, for tour packages, and for other purposes, now they've brought in this 20% withholding. Earlier, there was a minimum threshold of 7 lakhs and a 5% rate beyond that. And now, sir, that has been raised to 20%. Now, as we understand, TDS can be for tracing and tracking, and therefore there could have been a token rate. But I think in the past we've heard the government saying that, look, a token rate is not effective because many people still don't file returns to claim that. And therefore, we thought the 5% should be sufficient. But that now going up to 20% when the Reserve Bank itself in its policy has given this $250,000 a year limit, it seems to be, contradicting the Reserve Bank policy itself. So we just wanted to understand, sir, is there a thought process, and will this be something that can be reconsidered?
So starting with a lighter note, so I was thinking why Mr. Rakesh Nagia has not invited me for the party. So one was TCS on LRS, then market-linked debentures, then insurance policy, then business trust income, then capital gain taxation, 10 crore. You say you gave me only one concession of 42.7 to 39, but you took away more than that through these 5 proposals.
I think so. That goes without, definitely before budget now.
So on a serious note, see, Chairman in the previous, his inaugural address has replied to this question. So I will not like to say anything more, but my normal question that is being asked to us whenever there is a new TDS rate or new TCS rate or increase in TDS rate or TCS rate is, that is a reply you might have heard before from me. That is, India is not as compliant tax jurisdiction as some of the advanced countries are. And therefore, they don't have to rely much on TDS and TCS. Their tax compliance is already very high. In India, because the tax compliance is improving, it is much better than what it was few years back, but it is still up to not that level. So we have to rely more on TDS and TCS provisions. And we still do AIR, we still do, obtain information and populate your e-filing account with those information so that you file your return correctly. So these are new steps. Once these steps becomes very useful in enlarging, widening and deepening our tax base and making more, taxpayers more compliant, then probably there will be less emphasis on TDS and TCS. Right now, this was one area where one felt and with the actual, experience that they are high net worth individual who invest overseas and they do not have that kind of income in their tax return. So there is a provision to increase TCS rate. And it is also a realization that these high net worth individuals also have to pay advance tax. So if they have a TCS, they can reduce the advance tax to that extent. Or in case it is not advance tax because their tax get paid through TDS or some other mechanism, then they can claim refund in the next year. So that is the thought process behind this particular move.
Sir, is any possibility of reconsidering the threshold? Because if you're really targeting the HNIs, that 7 lakh threshold that was there, if that can be reconsidered, just a request, sir.
We have noted it down, and definitely, whatever suggestions we receive, we will examine them.
Or alternatively, if you want to cover everybody, instead of 20%, keep it at 5%, right from 1 rupee of expenditure itself.
So it can be on complete LRS, all expenditure, we are saying. Yeah, that's much better.
No, that's...
So
please listen to salaried people like us also. Okay. No,
So
it's not that simple. It's not that simple. The mathematics is different. Okay. Let's say, because now the income has been disclosed, let's say I've paid 39%. Okay, fine. So what remains, and I'm a salaried person, I don't pay advance tax. 61% remains with me. Out of that, let's say I have kids outside, I have to maintain them, or maybe for a EB5 or something, I want to remit money, or maybe I want to spend my money for domestic travel. If I spend on my domestic travel, let's say 50 lakh rupees, nobody asks me any question because I did not to pay any TCS, etc. But the moment I step out of country, I have to pay TCS, 5%, fair enough. I'll get a refund of that. Now, let's say I have son outside, or I want to help him to buy a house, and I want to remit 1 crore rupees, which is well within my LRS limit. This money is out of my tax paid money. When 39% I've already paid because it has been deducted. Now, balance 61, if I want to remit it there, I have to still pay 20% TCS. That means my disposable money has gone down. It's a serious cash flow issue, sir. What happens that if I want to remit 1 crore rupees, 20 lakh rupees has gone to the government, which will come to me 1.5 years later. So I'm left with 80 lakh rupees. I mean, what wrong honest taxpayer who has already got his money withheld has done? So probably this method is right because there are so many high net worth people who are remitting and not reporting. So probably can we put a check there that yes, whether this person has filed his return in earlier year, and for them this would have been the TCS rate, and for the other one this is a higher TCS rate, because this becomes a serious cash flow issue. Sometimes even if for people who want to remit money for, let's say, fees for their wards, 5% or 10% is a big hit, sir.
So just to answer this question, let me see this way. First of all, you said that can we put a check that return is filed or not. See, just merely filing a return is not enough. As I said, that they are filing their return, but that income is not commensurate with the what they
so
are
that kind of check is
remitting.
also, can that be
No,
become
that
other
will
check?
become very complicated. Filing return is easier. We have come out with a utility also. Authorized dealer just have to put those PAN and he will get to know whether he has filed return or not. So that is easier to comply with. But going beyond to say who is going to do that subjective assessment, whether that is commensurate or not.
So then the cash flow issue has to be addressed, sir. Somehow
Cash flow address, once again, if somebody is 39% tax on his salary income, now, not going personally as such, but, even I can address myself also, that those who have a salary income, and they don't have much responsibility and high salary income, that they do have other income in the form of interest or dividend or whatever, capital gain. There is no TDS on capital gain, interest and dividend only 10%, but you have to pay higher tax rate. So you still have to pay advance tax. You understand? So it is not a situation that you are a high net worth individual, high salary income, you don't have to pay advance tax. So that is not a situation. Maybe, you will still have a cash flow problem, I'm not saying, but it will be little less. And so far as foreign traveling is concerned, our Prime Minister has said, "Dekho apna desh."
Thank you, sir. You have summed it up very well. Just two suggestions. One,
And Rahul has recorded it also.
one, if you can look at a threshold limit. If no threshold limit, 20%, 5%, because you will have your audit trail maintained after that. Okay. Amit, new global tax rules, OECD Pillar 1, Pillar 2, lot of developments taking place. Few countries like Netherlands, Germany, Ireland, etc. are going ahead with the draft legislations. We expected probably some direction coming in this year's budget. Where does the word stand today? And then we'll ask the department's perspective also on that.
Yes. So, sir, on Pillar 1, which is the, heavily debated, which has been going on for a while, I think there seems to be some hiatus in the global consensus because of the US position. So, I guess on that, since we are not clear which way this will go, one question that we do have is what happens to equalization levy? Because in the past, there has been thought process that when, Pillar 1 is introduced, equalization levy, which was intended as a temporary measure, may go away. But does this mean now that EL will probably continue? That's the question on Pillar 1, sir. And on Pillar 2, as Vikas said, there is like Japan, Korea, EU, they're all moving ahead. And there seems to be a consensus. Of course, I think India doesn't stand to gain much because we already have, the minimum tax rate. Of course, the subject to tax is something which is helpful for India. But anything, and I think the Honorable Chairman in the morning did address this point, but any more color from you will be helpful, sir, because most industry was expecting on both of these something.
See, on equalization levy, that, India has already said, many times that once we have a consensus on Pillar 1 and India is part of that consensus, the date when Pillar 1 starts being implemented, that is also will be the time when EL would be withdrawn. So that commitment is already given. Let us see. I mean, those discussions are going on in spite of a lot of challenges that is being faced. But still, and this is presidency of India in G20, and we are very hopeful that this year might be the watershed year for both Pillar 1 and Pillar 2. So yesterday only, or day before yesterday, OECD announced the final report on Pillar 2, but it is only on income inclusion rule. It is still not on subject to tax rule. So that is also one part where India is interested. So while OECD may have said that, this is the final report on Pillar 2 and Pillar 2 is now, for countries to implement, but we still have our interest in subject to tax rule. So let us see how these, what is the future and how these consensus are reached on that particular aspect as well as on Pillar 1. And definitely, India would be very interested once there is a consensus to start implementing it.
Rakesh, we were debating on this in terms of digital tracks and the SCP. Any thoughts on that, significant economic presence, whether they are overlapping some issues?
So very briefly, one is SCP, I think this has been discussed last year also. No rules, computational rules have come. It is already implementable now. And we are at times long, and how do we attribute actually? And I think this has become a lot of time. Personally also, I've tried to make a representation. Now the returns filings are there. We do not know basically. Do we go back to the standard P attribution rules? Because when there's nothing like that, we don't see there's any mechanics with us to find out how do we compute that. And second, on digital parts, sir, there was one of the query, I remember you saying it doesn't need any more clarification. But since it is applicable now, no, it has covered everything basically. If you see vanilla reading, everything comes digital now. Do we presume this 2% tax will actually come on everything which is even non-digital? So basically a little bit of clarification will end it. That's the basic. Objective is only a clarification.
Yeah, good question. So basically, as we said that, as I said earlier, that a lot of deliberation happened on various issues, including these issues. So what you see in the finance bill are only proposals that needed amendment in the Income Tax Act. But there are, there are proposals in the mind of government which will get resolved through amendment to the income tax rules or through circular. The profit attribution rules is definitely one which is in our agenda. That report was circulated in the public for feedback. We have that feedback with us, but we did not pursue it further because Pillar 1 work was going on. But we do realize that this is one issue where we need to come out with some kind of a rule earlier, and definitely this is one issue which is in our agenda. And clarification on SCP also, something we have that in our mind. We'll see how we go. But that is one thing that what you see in the finance bill is not the end of the matter so far as taxpayer-friendly measures are concerned. There would be further steps during the year.
Thank you so much, sir. This is a very big consolation.
Yes, sir. Thank you very much. I think it's on agenda. That's the loud and clear message, and we will see some clarification rules coming on that. Sir, I want to invite your attention to the capital gains change that has been brought in terms of the house property income. What was the rationale for keeping a threshold of up to 10 CR in terms of the tax benefit getting restricted over there?
I don't know whether, whether it could be 10 CR or 5 CR or 7 CR, that is something which is always subjective. There is no, you can't say why only 10 and why not 8. That is probably something very difficult to answer. But rationale for putting a cap is necessary. How many people buy a house of more than 10 crore, only high net worth individual? This provision is there that when you earn capital gain and you invest in house property, you don't pay capital gain tax. Now try to understand that capital gain tax is already taxed at concessional tax rate in India. If you see high net worth individual, most of their earning is through capital gain. And that means they don't pay tax at maximum marginal rate, whether it is 42.7% or 39%, or for dividend it is 35%. But they try to, convert all their earning into a capital gain and pay tax at 10%. So whether they design insurance product or whether they design MLD, whatever, the entire emphasis is how to convert my 42% income into 10% income. So even after converting that into 10% income, they don't want to pay that 10%. And we have seen cases where houses worth 160 crore, 200 crore were bought, and capital gain tax was not paid on that 160 and 200 crore, which was just 10%, which is wrong, absolutely wrong. I mean, that is something inequitable. The fundamental principle of direct taxation is that rich should pay more. It shouldn't happen that we middle class pay 30% and the rich class is paying only 10%. and that too he is avoiding that 10%. So the rationale is very clear.
Sir, I'm completely with you when you mention the middle class should also benefit. Sir, is this policy change directional in terms of that the intent is to gradually do away with the capital gains exemptions available, or is it just a one-off change as of now? I know tomorrow things will change, but is it more directional that next year we'll see few more sections going away?
No, there is no such indication. I mean, as of now, it is just putting a cap because of the rationale that I gave you just now.
Great, sir. So you have brought in some changes in context of the foreign money coming in form of debentures, etc., 194 LC, etc. I think there was a provision that allowed the concessional rate of TDS up to this year, 23 in between. Now that has been withdrawn. Is it very intentional or that's under reconsideration?
No, that is a conscious call. As I said, even this proposal, there was a lot of discussion at length, and we did realize that by restricting our right to 5%, we are even going down below our tax treaty right. Tax treaty normally gives us a right of 10%. Most of them, some may even give you higher, but mostly 10%. We are even going below that 10%, and we did it. It was a conscious call at that point of time because our economic condition, our foreign exchange reserve mandated that we should give up that right for a certain period, because we wanted those concessional loan. Situation has changed. The current situation is not as it was that time when these two sections were introduced. And, now the government does not find justification for letting go its taxation right in favor of some other country.
Thank you. If you are a corporate, please take note of this. This is a significant change in the fine print, and especially if you are borrowing from overseas, this could impact, and now there will be again an interplay of the respective treaties. Please take note of that. Vineet, industry perspective, one or two big hits, one or two big misses.
No, as far as industry is concerned, the biggest hit is that consistency of tax rates and not much tinkering. So actually our policies continue to be the same, but because last year much havoc has happened because of that 194R and everything. Of course, there is one big amendment which has happened, and probably that to undo that that Supreme Court decision in Mahindra and Mahindra. But there is probably an unintended or intentional impact of that now the loan write back has become taxable. Because for last 30-40 years, how the jurisprudence has emerged is that loan write back, and certainly those loans which have been taken on capital account, write back was not taxable. Of course, probably this is an intentional call. If it's an intentional call, sir, there may be some unintentional hit on another very progressive step of government, which is IBC. Because in IBC cases, invariably in all cases, these loans are written back. And if these return back loans are become taxable now because of withdrawal of this case, probably that those valuations which the lenders are getting, they will not get it, and probably it will impact. So if it's intentional, this loan write back was to be made taxable, probably a carve out has to be made as it has been made in Section 79 or other sections of Income Tax Act to just give effect to that in IBC cases, probably this clause will not apply. So that's my suggestion. And again, it's for the government. As far as long-term capital gain is concerned, there is an anecdote in Mumbai, I don't know about Delhi, but there is a big industrialist who actually, I think he just let go, that he reduced his equity holding in a newly launched IPO from 100% to 75, and probably he bought a house of 1,000 crores and got an exemption under Section 54F. Okay, so certainly it is agreeable that these kind of exemptions are not sought. When this 54 and 54F was introduced, that the intention is very clear to get impetus to housing, not to the mentions. So probably somewhere this loophole has to be plugged, and that's rightly been done. What has been missed, I don't see much. 194R is one. Second, we have already discussed all these 5627B, etc. ये दिल है कि मानता नहीं, चीजें बहुत सारी हैं, but as far as indirect tax is concerned, there were certain asks which have not been certainly. One, this morning it was discussed, input tax, ITC on CSR expenses. And generally the government position is very clear that CSR expenses, you bear on your own, government will not become party to it. I think, sir, that 37 amendment came in 2015 or 16, and now the GST has followed it. But there are nuances to that. Of course, government doesn't want to become party to that, so CSR expenses which are mandated by other law, and it cannot be said that they are not business expenses. Anything imposed on corporate by law becomes, because it's a matter of survival, it becomes their business expense. And GST input credits are, nowhere it is written that all these input credits should be, of course this is not direct tax, nowhere it is written that ITC should be related to your business expense. It says your input expenses for, in normal course, okay. It should be particularly for business only. That's for income tax, not for GST. But there's a fallout to this. Now let's see, a corporate is spending 100 rupees on CSR activities. And let's say there's a GST of 18%, so total cost becomes 118. Right now it was taking ITC, it was foregoing it, it was taking ITC, and 100 rupees was actually being booked as expense, and it's going to CSR activity. Now if you're denying that ITC, the 118 will not become CSR expense. 118 will be reduced. So the needy will get only 82 rupees. So that will be the direct impact. The second thing, when ITC was being taken, you know, every part of that is getting reversed. So actually the corporate was not availing entire 18%. Part of that got reversed. Certain inputs which were going for civil structures were not even being availed or being reversed. Now everything, so basically corporates are not at loss. If you see it from a positive mind, I'm not talking about those corporates like mine. We were spending money when there was no CSR. And still today we are spending more than 2%. But I'm talking about those people who are restricting them to 2%. Probably this will benefit you.
Thank you, Vineet. Sir, any thoughts on that? Because your colleagues on the indirect tax side are telling us that we are not allowing input tax credit because it is not allowed under direct tax as an expense. So, so maybe you can allow us as a direct tax expense, they will allow us an input tax credit as well.
No, I mean, there is no proposal or no thought that it should be allowed as an expense. That's a clear-cut, thought that it is below the line item. And, you are supposed to do corporate social responsibility. Let's not government be a part of it through 30% share or whatever, the number that is. On that, the loan write-off will become taxable, and for IBC companies, it should be addressed. First of all, I have a basic problem in understanding if I am a bad company in the sense making losses, therefore I have gone to IBC. If my loan has been written off, how can I turn into an income? I have asked this question to many, nobody has been able to explain. That means if it has turned into income, that means my losses are less than the loan. Then why my loan should be written off? This is a very fundamental question. How can I turn into a profit by writing off loan when I am a sick company?
There are cases where there are no accumulated losses. Companies suddenly become lost because they are out of business or some other reasons. There are cases, sir. I can give you examples.
You give me that example, but very difficult to understand.
We will take it up with you,
in any case, in IBC, even if I turn into taxability, income tax is not going to get its share. It's way down in the waterfall. Post IBC, yes. So
this becomes a post IBC issue,
so
sir.
You refer to all those IBC concession. That is only doing IBC, not post IBC.
No, sometimes post IBC, like post IBC carry forward losses have been allowed combined, even because of change of ownership under MET also.
That change of ownership only.
So those kind of exemption is there. So similarly post IBC, because this is unintended tax impact which will come.
Perfect. I've been warned that we have another interesting session coming up on the indirect tax side. Sir, thank you very much for joining us. Great discussions, deliberations, and thank you for your clear insights and perspective. I think we have better understanding and appreciation of why the provisions were introduced, the rationale and the thought process. And also, once again, on behalf of the Chamber and all the participants today, thank you very much for being a patient listener and responding to all our queries. I also want to thank my panel members, Vineet, Rakesh, and Amit. Thank you very much. And as sir has mentioned, he is open to any suggestions please route it through the chamber and we will take it up with the department. Thank you very much.
Thank you, Vikas, for steering that discussion. Very interesting, very interactive, and I'm sure a lot of questions have been answered. A lot of deliberation has also happened because direct tax is an issue that remains quite sensitive. I'm sure you've enjoyed this. A round of applause for all our speakers who have shared their experience, their thoughts with everyone. Thank you all for joining us. We shall now move on to our the analysis of indirect tax related proposals. Now, ever since we moved to the GST, when it comes to indirect taxes, the budget is not one where we seek a lot of clarity. And this time it was a mixed bag. But when a time comes like now where the middle class is squeezed between rising interest rates and higher inflation, any relief announced in the budget by way of customs or excise is a big welcome. Now we are going to go ahead and talk about the indirect tax related proposals, and please join me in welcoming on stage our speakers for this session. I would like to invite on stage Mr. Sudipta Bhattacharjee, Partner Indirect Tax, Khaitan & Co. Please put your hands together and welcome on stage Mr. Sudipta Bhattacharjee. Joining him on stage are the other speakers in this discussion: Mr. Rahul Khurana, Partner, Economic Laws Practice; Mr. Siddharth Tandon, Partner, Indirect Tax, BDO India LLP; and Mr. Shrey Gupta, Head of Tax, Schlumberger India, Sri Lanka and Bangladesh. Please put your hands together and welcome our speakers on stage. We have our moderator, Mr. Sudipta Bhattacharjee, Mr. Rahul Khurana, Mr. Siddharth Tandon, and Ms. Shrey Gupta. I'd like to hand it over to Mr. Bhattacharjee for steering this discussion forward.
Very good afternoon to all of you, to my esteemed panelists. The conventional wisdom since yesterday has been, I mean, if you look at all the WhatsApp groups, professional WhatsApp groups, indirect tax is but thanda hai. Not much has happened. I'm hoping that in the next hour or so, we should be able to come up with at least a few pointers, few important takeaways, and earn the privilege of your time for the next hour or so. Right. So what I'll do is, before we go on to the panel part of the discussion, just to set the context, I will try a quick overview of what are the key changes, and then move on to discussion on some of the more nuanced talking points. So without further ado, I think the biggest change, of course, is much talked about since morning, the CSR part of it, which is obviously came as a bit of a surprise, especially because a lot of advanced rulings were coming in which were favorable, which were sort of upholding that right. Even pre-GST, there were favorable decisions which allowed this particular credit. We will talk more about it, I think, in the course of the panel discussion. Next is decriminalization. Now this, of course, flows from the GST Council recommendation itself. 3 offenses are sought to be decriminalized. And I dare say these are minor offenses. The reason I say minor offenses is because even today they are categorized as non-cognizable and bailable. So even if I am arrested today in any of these, I can get a bail automatically from the police station itself. I don't need to go to the magistrate. These 3 offenses, obstructing or preventing the officer in discharging duties, deliberate tampering of material evidence, and failure to supply information, is being removed from section 132, which is the source of the prosecution of criminal liability provisions under GST. Also, threshold for initiation of prosecution is being enhanced from 1 crore to 2 crore. Again, this flows from the GST Council recommendation, except for fake invoices. For fake invoices, threshold continues to remain at 1 CR. Now, and again, this is something we'll deliberate in the course of the panel discussion. Is this far enough? Step in the right direction for sure, but could it have been more robust? Because if the intent is to actually decriminalize, we have to realize that why do we decriminalize? It's tied to ease of doing business, right? We don't want businessmen, entrepreneurs to be under the sword of a threat of prosecution ever. Decriminalization, I think, is only one aspect to that. The second aspect, and this is something I talk about very frequently in all public fora, there has to be a mechanism for accountability. An officer who comes and threatens arrest to do recovery without following the due process of law, there has to be some sort of accountability at an institutional level. There have been high courts which have imposed costs, but that's too sporadic. We need an institutional mechanism to curb this bad behavior. Again, there are circulars. You can say there have been 3 or 4 circulars already. But what happens if you don't follow that? Where are those 3 or 4 exemplary cases where people have disciplinary action has been initiated? Again, we'll talk more about this as we go forth. Another aspect is the compounding part of it. Sorry. Yeah. Another aspect is the compounding part of it. Now, 5 years of GST, guess how many cases of compounding had happened? Any guesses? 0. Not a single case of compounding happened in 5 years of GST, even though on paper, it seems like an attractive option. I mean, it's a new law. Companies may have committed mistakes inadvertently, mistakes which trigger some of the prosecution provisions also, even though there may not be a clear case of intent to evade. It should have been a no-brainer. I do a lot of work on the state excise side, which is the tax pertaining to alcoholic beverage companies. And compounding is one of the most popular options to deal with litigation, to deal with disputes on that side. Unfortunately or fortunately, under GST for 5 years, there has been no instance, and which is taken note of by the government, and they have tried to liberalize the compounding provision. The threshold, earlier it was a minimum of 50% of the tax liability had to be paid and a maximum of 150%. It is now changed to 25 and 100. So by paying, theoretically, by paying as low as 25% of the tax liability, you could go for compounding and basically settle the case once and for all, along with criminal liabilities. Now, this is the positive part, or this is the refinement, or this is the liberalization that has happened. What remains the same is the fact that it is still a once-in-a-lifetime opportunity. So you cannot do it more than once. It's a silver bullet. Once you have utilized, once you have done compounding in your entire life cycle as an SSE, you cannot do it once again. And if you think of, I mean, at a surface level, it seems like a reasonable thing. That, it's a criminal liability after all that we are trying to get rid of. But think of this particular scenario. Fake invoicing is a heinous crime. There is no two ways about it. But think of a scenario where, and many of us might have been involved in that sort of structuring, where there are 2 branches or 2 registrations of the same company located in 2 parts of the country. In one place, there is accumulation of credit. And one invoice is raised, a cross-charge invoice is raised to transfer that credit to the other location where it will get utilized. Very, very common sort of transaction. Thousands of such instances would have happened. If you read the section 132B carefully, this squarely falls under that. Because you have raised an invoice, a registered person has raised a tax invoice without actually providing any service. Because in most cases, there would be no actual service. I mean, we can say support service, we can say whatever documentation we may prepare. Hand on heart, we know there is no actual service, and we are just doing this to transfer credit. It's a reorganization of credit, right? But that also technically can trigger 132. And if that has happened, shouldn't the SSE have the chance to opt for compounding? So I think that's, we will discuss more on this. One thing to remember is for fake invoicing, like we saw for prosecution threshold enhancement, for fake invoicing, again, compounding option is not there. So remember my example, and remember that we don't have the option of compounding in this sort of a scenario. And also, the threshold for enhancement of prosecution from 1 to 2 crore does not apply to fake invoicing, applies to all the other offenses. So a step has been taken, it's in the right direction, but one hopes for a lot more in that direction. I think the next part is e-commerce. You know, it's a booming sector. We all know a lot of our economic growth is credited to this particular sector. What has happened is, you know, India was probably one of the pioneers in terms of, as a tax policy, to do platform taxation. And what do I mean by platform taxation? You remember the aggregator rule under service tax, where the likes of Uber, Ola, etc. were made to pay tax for services rendered by their driver partners. This was a very radical concept at that time in a global tax policy. Now it is becoming common. Now EU and other parts of the world, they're aligning to this concept that yes, the platform, e-commerce platform can be made liable to pay tax on behalf of the service providers or suppliers through that platform. In India, we have two forms of this liability under GST. One is the TCS liability, tax collection at source. So the likes of Amazon, Flipkart, etc., they have to do a tax collection at source for the money that is flowing through the platform. And the second is under 9(5), where we have the likes of Uber, etc., where they slip into the shoes of the supplier and they pay the tax themselves. So far, so good. What is being proposed is a new offense against the new offense which can apply against an e-commerce platform for violations by suppliers on that platform. If I am a unregistered dealer, my threshold last year was say less than 20 lakhs, but this year I'm supposed to register. My registration liability has triggered, but I have not registered. And I make a sale on that platform through Amazon, through Flipkart, through any of these e-commerce platforms. As per this proposed amendment, they will be liable to a penalty. 10,000 is the minimum, but what actually will happen is the amount of tax that I was supposed to pay. Now, how far does a Amazon or a Flipkart have the ability to ensure that I do my compliances as a supplier? They can ask for details, they can do one level of KYC, but that status is also dynamic. How far do you put the burden of the revenue on the players, on the e-commerce platform? Because that's what effectively what we are saying is happening. You know, if I'm a composition dealer, I'm not supposed to do interstate supplies. But today, if I log on to the platform and, you know, I'm based out of Delhi, I sell something to someone in Gurgaon. How does the platform track it? But if it does not, there is a penal provision on them that is being proposed. To my mind, it is a little onerous. It is in line with what the government has been doing, where, you know, ITC related provisions, a lot of the onus has been put on recipients instead of the suppliers. It is in line with that sort of theory, to my mind. We'll talk more about that as we move on. OIDAR. I think OIDAR is for, I mean, if any of you do not know or is not familiar with OIDAR as a concept, it is the Indian version of digital services tax. A lot of companies earn money from people like you and me, individuals like you and me, by supplying us with content, by supplying us with online education, etc. Globally, there has been a talk about why shouldn't these companies pay tax in the country where the customer base is, and different countries, I mean, equalization levy is a manifestation of this theory, and many countries have many versions of this digital services tax. India, under indirect taxes, it came in the form of OIDAR. But if you look at the definition of OIDAR today, it is very, very specific. The definition features words like complete automation, minimal human intervention. And there's a lot of people like you and me, I mean the consultants here, we are doing a lot of structuring around this. We were trying to, like in an online education scenario, we will have a actual teacher come in and take a few classes to overcome the minimal human intervention test. Or if you look at the definition of non-taxable online recipient, see, the reason why OIDAR became a challenge is because if as a OIDAR provider, you are providing to a non-taxable online recipient, which was effectively people like you and me, individuals, unregistered individuals like you and me, the OIDAR player from outside India had to take a registration in India and pay GST on a forward charge basis, which is very, very cumbersome for many of the players. And of course, it was not being implemented very aggressively, but the law has been there. What is now being proposed is to remove many of these ifs and buts, many of these nuances from the definition. So effectively, any online service, any digital content or service being provided to any unregistered person in India will fall under YDAR, and all the consequences of registration and payment of GST on forward charge basis will follow. So I think this is something, to my mind, this is a directional change. I mentioned that so far Indian authorities have not been implementing this in a very aggressive manner. Probably this shows the intent, or this indicates that in future they are going to be, the change gears on this and implement this rather strongly. I think few minor procedural changes, I'll not spend time on these. Effectively, enabling provision has been made to share our data that is there on the portal with other agencies, thankfully with our consent, but practically how it will happen, we'll have to see. Is there any data leakage, etc. There has been clarification made retrospectively that things like inbound sales, or where supply of goods is happening from foreign country 1 to foreign country 2, there should be no GST in India. I think everyone was aligned to that position. It's just the legal sort of recognition to that from 1st of July 2017. No refunds to be granted, and we will see whether that particular aspect of it gets challenged in courts. I think I'll quickly move on to customs related changes. One thing that really struck me as very odd is, this reintroduction of timeline for settlement commission. This was a provision that was there prior to 2015. It has now come in again. What it basically says is, if you have applied before the settlement commission, customs settlement commission, within 9 months, the case has to be disposed of, heard and disposed of with a final order. If it does not happen in 9 months, basically you're back to square one. It is as if you never went to the settlement commission, you're back to the customs officer or whoever is the adjudicating authority. Now I really don't understand the logic behind this. How can I as a SSC control the period? Or, okay, you punish me if I have adopted dilatory tactics, if I have taken 5 adjournments and I have not given documents when asked for. But how can there be a broad brushstroke thing that 9 months and you are done? In fact, sorry? Correct.
You should even consider that it has been accepted by the
I wish. No, in fact, I mentioned it was there before 2015, and there were court cases at that time where courts had taken a more liberal view and said that if the delay is not attributable to the SSC, you can't punish that SSC by saying 9 months. So I don't know why we want to restart those entire set of litigations again. So this is a very strange proposal to my mind. Another thing that has come is under the Customs Tariff Act. This is more on the international trade side. So some of you are familiar with international trade would know, and it has been an oft litigated issue there, that at what time, if I'm an Indian importer and I have applied for imposition of anti-dumping duty on a particular product, at what stage do I file an appeal? When the Director General of Trade Remedies has given a final finding to the ministry saying that yes, anti-dumping duty has to be imposed or not, or should not be imposed, or should I wait for the notification? And there have been CESTAT judgments, other judgments where they have said that yes, you can go against the DGTR report at that stage. Recently, there have also been judgments where they have said, because some of you would have read in the newspapers that the central government, despite a DGTR recommendation, decided not to implement anti-dumping duty. I think there have been 3 or 4 such instances in the last 1 year or so. And a recent judgment came in where the courts were asked to consider that can we appeal against this particular office order or executive decision of the central government. When the DGTR has recommended, how can the central government decide on its own that nahi, hum to implement nahi karenge? And the court has held that yes, this is a quasi-judicial thing and you have to hear other parties, affected parties, before you decide not to implement something. I think this particular amendment is a fallout of that entire debate or that entire litigation that has happened. They are basically making this a retrospective amendment from 1995 when this provision first came in. They are saying that yes, you can appeal at the stage of the recommendation itself. Now the question is more practical. If I as a affected party do this and then the notification comes in, do I amend my pleadings, add the notification also? Do I file a fresh appeal? I think that we'll have to see as we move forward. But the other part where appeal against the central government's decision not to implement a particular recommendation, I think the writ route will continue to be explored, because I don't think that's going away anywhere. A lot of tweaking on the rates. I will not spend individual time with the sector, but a lot of tweaking on the rates have happened, mostly to encourage domestic manufacturing, domestic value addition, green energy, mobility, etc. Excise, I think, like always, NCCD rate on tobacco, cigarettes have been enhanced, and for blended compressed natural gas, a partial exemption has been provided. So I think with that, I will reach out to my esteemed panelists, and I think let's start the discussion with the most talked about topic, which is CSR. Shrey, if you want to start, kick off the discussions, as someone from the industry, what is your thought, good, bad, ugly? Where do you stand on this?
So I think in my perspective, I completely disagree with this amendment wherein they are denying the input credit. And I think before this session, as Vineet was also pointing out, I mean, at the end of the day, I understand that, you're sort of, as, the ma'am also mentioned in the morning, that you have to align it with the income tax provisions. But my point of view is that the benefit that is going to the society is in a way getting reduced, right? One. Two, I mean, there have been judgments specifically for catering, etc., wherein you're saying for factories that you are allowing the credit. But here, which is also a statutory obligation as far as CSR is concerned, you're disallowing the credit. So I don't understand the whole concept of this, but at the end of the day, if they have brought out a law, I mean, the only positive side I see is the clarity that they've given now. I mean, there were multiple advanced rulings which were favorable, which is also, something usually you don't expect. But yes, in my view, I don't agree with what has been done as far as CSR is concerned.
Siddharth, any thoughts on that?
Yeah. So I think overall from this amendment, what we have seen is, while I think as Shrey mentioned, and even in the direct tax session, that it's not really desirable from an industry point of view. Even from an optics perspective, what we see in section 17.5 proviso, where any statutory expenses vis-a-vis employees are already specifically covered, even optically doesn't sit well, that once you are allowing statutory expenses to be taken credit off, why create an exception here? The larger point in any case is that as part of CSR activities, we often see that companies are adopting villages, doing welfare function, at least in some portion, and also working towards green or sustainable measures. So from a larger government's vision in terms of welfare and moving towards sustainability, I think this would only cut corners for corporates towards the government's mission and vision in those areas. So I think from overall perspective, it doesn't sit well, but yeah, I think from a direct tax and indirect tax sync is what they've looked at.
From your perspective, how do you see, in the context of past litigation, how do you think this will affect or not affect past litigation on the issue of ITC?
So certainly, with respect to, of course, it's not which is much desired by the industry, and so far as legal point of view is concerned. So for the past litigation, of course, there was a position which was prevalent that these are the activities where you can actually take credit. So that position was there, but knowing that the specific provision have been inserted, so therefore post this date I will not be able to take that position. But it also gives an indication that because there is a new development, there is a new change. So that's how my previous position gets much stronger. Because something which has come, which was not there in the law, I can certainly take a position that this was the amendment which is prospective in nature. And certainly my previous year's credit will not be challenged in that ground. But we know that similar scrutiny or similar questions has already been raised on the CSR activities.
Right. Okay, I think it will, I don't think the government, the department is going to so easily accept this particular point of view, but I think more or less it is fair to predict that in courts, this particular amendment will help at least protect us for the past period. Another thing that came up, this was part of the speech, not part of the Finance Act, the Honorable Finance Minister mentioned about a Vivad Se Vishwas scheme for contractual disputes. That things where matters are in arbitration or arbitration award is under challenge, graded settlement package sort of a thing would be explored, which is hunky-dory, which is all fair. But as some of us know, there have been many a demand against settlement amounts, many a demand of GST against settlement amounts. So one wonders what will happen when this becomes a norm or when many such instances of settlement happen. Any thoughts on that? Siddharth, maybe we can start with you.
So I think this section in that sense has seen a lot of movement in any case, even in the previous tax regime. If we see, there have been a lot of disputes, a lot of discussions around this. In fact, last year we saw the circular also coming out on liquidated damages, where they said and spoke about different situations which could arise, where one, it could be taxable. Two, if it's a breach of contract, then it's not really taxable because that's not the intent of the parties. So I think in that sense there has been a lot of development, and the government has also matured throughout this journey. But has that deterred the department from creating demands or initiating notices or any litigation? The answer is no. I mean, we have seen enough and more matters being taken up across locations, and the approach is to how to distinguish from what is liquidated damage. So even we have seen enough and more situations where they have distinguished the circular as well, or favorable judgments. So where do we go from here is something to be seen. Hopefully whatever settlements are arrived at from a contractual perspective should not be subject to tax, but that's what we feel from a technical perspective. We'll need to see how the department really embraces the outcomes from these.
If I can just add to this, I think the very basic premise, when FM was giving a speech, was in line of obviously ease of doing business as well, and obviously to bring in more investment from the foreign players. Now, if we were to sort of interplay this with the GST demands, if they were to arise, right? I mean, you are actually defeating the purpose of bringing such a scheme in first place. So I think a clarity or a clarification or maybe an internal instruction has to come out, saying that if there's a settlement happening under this scheme, then there's no further dispute that can arise under any law for that matter. So I think that clarity is very, very needed, at least by the industry, I would say.
Yeah. To my mind, these will more depend on very case-specific things. So if my award is in the nature of, let's say, of additional consideration, so that may take a color of, which attracts GST. But certainly, which Siddharth has also mentioned, there was a circular which talks about liquidated damages. If my consideration or my flow of income is towards breach of any contract, and it's because of injury which was caused to me, so on that basis, I can definitely take a position that this is not a consideration for the purpose of GST, and these are merely the contractual obligation which has been set up. So that's how I think there is still a window, but each case has to be decided on, this has to be decided in case-to-case basis, I would say.
I think the concern arises from the fact that, many of you would have read in the newspaper about the Tata Docomo case, where a massive amount of settlement, and obviously the parties thought that this is the end of it, but now a GST demand and a massive GST demand on that has been placed, and the matter is now before Bombay High Court. So one wonders that, and the trend of Ministry of Finance or one ministry acting in cross purposes with another ministry is not new in India. I would dare say that even the CSR example, to my mind, the Ministry of Finance is acting at cross purposes with Ministry of Corporate Affairs, because the overall amount that is going in for the social welfare is actually getting reduced if you are, that is the tax policy you are going to follow. So I think it remains to be seen how, or rather one hopes that sufficient clarity is announced, is brought on, especially vis-a-vis settlement amounts, settlement deeds that are entered into pursuant to this or even otherwise. I think now let's come to an interesting amendment, and I didn't touch upon this during my overview speech. What has happened is, all of you know the provision where there is a credit reversal when you don't pay within 180 days, right? And most of us have been complying with that. the earlier provision used to just say along with interest, without quoting the source of interest provision, which is section 50, right? It just used to say along with interest, and many lawyers, including yours truly, have taken this argument that for this kind of a reversal, there could be no interest, because power to levy interest under a tax law is not automatic. It has to be there specifically, as through come out through a section specifically. And to the extent it was not there, it was not referred to specifically, you couldn't levy interest on this. Maybe the fact that they have now brought in this specific provision, we are going back to the same question, does it buttress the past argument for no interest? I think Siddharth, any thoughts?
I think it's certainly possible to sort of use this development as a case in favor. The other point of view, from a practical point of view, is also that this amendment is largely focused on realigning the practices on what happens on the portal when a person is filing the return. So typically, earlier it spoke about enhancing your output liability by the amount of, amount of credit which was supposed to be reversed. Now, in a lot of cases, we saw that practically people were actually enhancing their liability. Of course, interest was the other element, but rather than reversing their credit, creating a debit entry in their electronic credit ledger, they were actually adding it to their output tax liability. So one point of view is that this is just to bring in clarity. The other element, as you rightly said, I mean that of course, any change in the provisions does create a lot of room for interpretation. So those possibilities can certainly exist, specifically those where this has been contested.
Sure. Shrey, as someone from the industry, would love to have your view.
Yeah. No, so I think we will definitely take this argument that this change has been brought about prospectively. And apart from this argument, I mean, there have been other arguments in terms of the scheme of returns which were there earlier and now, and the law intended for GSTR 1, 2 and 3, and we are now, 1 is there but 3B is there, not 3. So I mean, with those arguments, I think, and with this additional point of this provision being prospective and more of an amendment rather than a clarification, this definitely will add value to the litigation that the companies may have as far as this interest component is concerned.
Yeah, I agree with both the points. Rather, this provision existed earlier also, and it takes us to the rules which was prescribed. So when it comes to computing interest, then I have to go by 32, which mandates me that this will be applicable only in those cases where you have a reconciliation, which was a mechanism which was earlier envisaged, but later on it was removed from the statute. So one, yes, there may be a position where you can say is it a clarificatory in nature, because this kind of wording were there in the previous law also. But mention of section 50 certainly will help. But the second point is there may be instances which Siddharth has also mentioned, like in case of investigation or in case of inquiry notices, where department comes to us and says, this you have taken as a credit which was not eligible to you because you have not made payment within the prescribed time limit. So in that case, there may be some instances where I am making that payment through DRC3. I am not doing it through return. So in that case, I have an opportunity that this provision doesn't restrict me to say it has to be added to your output tax liability. I can also make payment by reversing credit which I have taken. So that's how I think it's more kind of a realignment to my mind.
Great. Now let's talk about, I think we spent some time earlier also on decriminalization. I mean, one point of course is, are we going far enough, in terms of the ambit or the scope of decriminalization? What more could have been done, practically speaking, and the exception that has been carved out for fake invoicing, in absolute terms, without, I mentioned one during my earlier talk about how even in a more innocuous scenario, for a intra-branch or for an intra-corporate transaction also, a fake invoicing charge can technically arise. So keeping that in mind, let's start with you. What is your...
Just continue with your example. In those cases, I believe there has to be element of supply. Even if it's an incidental, you can say it's a support services, therefore there is a transaction of supply. But simply transferring credit from one branch to other, just because you have accumulation in one branch and sending it to other branch where you are actually making payment in taxes in cash. So may not be the right way to look at. Reason being, there has to be a underlying supply between these two transactions. And making an exception, I think the government has made it very clear that although you can take, decriminalize 1 or 2, 3 offenses, but when it comes to fake invoices, the approach is very clear that if somebody is found raising a fake invoices or what they call is credit routing, so in those cases, this provision will be applicable and you can't take the advantage of whatever relaxation which has been offered.
Fair enough. So, any thoughts on the threshold? I mean, it was 1 crore, now it has been made 2 crores. Of course, from the government side, it's doubling of the threshold. But, as always, dil mange more. But what do you think is a reasonable sort of a threshold in this sort of, in this case?
I think, thresholds is something, as you said, nothing is enough. So whatever the government comes up with, so even if they were to come up with 5 CR, probably we would have aspired for 10 CR. I think thresholds is one aspect. And increasing the threshold for a lot of these situations does help, in that sense. At least it shows the intent. But what is probably required even more is what kind of situations are covered and, how can those situations be minimized, where people need to really worry about this. So say, for example, if it is a situation of cross charges, where an underlying supply is not there, a lot of companies would cross charge just to mobilize credit. Now, in a regular scenario, cross charges could be a classic case to fit in here. What is required is clarifications in those aspects, so the number of cases that come into the ambit here, they are reduced, and that reposes confidence in taxpayers. Increasing thresholds, of course, helps, but I think a larger confirmation and clarification is required in those grey areas.
Shrey, any thoughts on this?
So I think from my standpoint, how I look at it is that how is actually getting transferred at a practical level. Now, I'll not speak much on the the monetary limit of it because it's very subjective to my mind. But what I feel is that if you are proposing something to be changed as far as decriminalization is concerned, I mean, it should actually flow to the ground, and it should actually be seen, when we as industry are dealing with the officers, how they are, sort of applying these changes that have come in the budget. So, to my mind, I mean, these are welcome changes, but a bit more clarity or maybe a bit internal circulars or maybe some instructions to the officers in terms of how to deal in such scenarios, that would be very, very helpful.
Right. I think one of the points that I was mentioning earlier, the decriminalization is only one aspect of it. I mean, what you are seeking to achieve is to ensure that no one weaponizes these criminal provisions against SSEs to collect tax without following the due process of law. Decriminalization has to be coupled with accountability. And I'll give you 2 anecdotes, and these are fairly recent ones. There's one, and it's at the outset, I must say it's a Chinese company. It's a huge Chinese company. There's a DGGI raid that happens. We go there, and they say that, you must deposit 100 crores straight away. And we say that there is a circular of your own department which says that you cannot collect tax in the course of a search and seizure proceeding. The person turns back and says that, you should show some Deshbhakti. This is a Chinese company. Why are you, doing this? So we had to respond saying that, either it's a policy decision. You ban all Chinese businesses, say that no Chinese business should operate in India. Everyone will adhere to it. Once you have permitted a particular business to appear, the usual rights and liabilities will accrue to any business that is in India. And when there is your own circular that you are not adhering to, you can't act holier than thou, right? And this is one instance, and there is another that I remember. This is about a year back. And this is for a listed company. The CFO has been locked up as usual, and he has given one phone call. He calls me, says that, they are saying 32 crores or cops are waiting outside, will straight away take you to jail. So I said that if you can sort of give away 32 crores, try and negotiate, but give away something because these guys are not going away anywhere. But let me try and talk to them once, and when we, as we were speaking, these guys say that, you know what, this is a listed company. All we need to do is leak a press release tomorrow that there is a raid and suspected 800 crores of evasion. What will happen to your stock price? You might as well pay this, whatever piddly amount I'm asking comparatively. And I was enraged, but of course I didn't do anything, couldn't do much, and I was trying to talk to the client that, we should bring these guys to the book. This is a threat of a stock market manipulation, right? And where, unless there is accountability in a very strong manner for these kind of bad behavior, you can bring in 1,000 circulars. I had a similar conversation with the member, the former member GST, Mr. Nagendra, and I was obviously talking very passionately about accountability, and he said, and this is just before those instructions came in that you can't collect money in a search and seizure, the arrest, etc. cannot be invoked except in extreme cases. All those things came in, and he said that there are things in the works. I said, sir, you can bring in, these legal points, are they anything new? The fact that you can't arrest someone or if the issue is interpretative in nature, it has been there from 1980s. Why are we still requiring to emphasize and reiterate that particular law? Because from 1980s you have not held anyone accountable. Every law, GST law, has a provision which says that no criminal liability or no liability can accrue to an officer as long as he or she is acting in good faith, as per the statute. But when someone threatens that your stock prices will go down, or invokes powers of arrest just to do recovery, is that acting in good faith? I don't think that shield is there to protect them when they're acting in such malicious and bad faith, but I think that is the only way. And I'm not saying, sort of go after all officers, but I'm sure there are top 1%, right? We need to go and we need to make examples out of that. So I think this is a larger point. Of course, one hopes that gradually we will move towards, because otherwise mere decriminalization, I don't think takes us very far. Moving on, I think penal liability on e-commerce operators. Any thoughts? Let's start with you.
Yeah, so definitely on a first blush it look quite onerous. Reason being, I being an e-commerce operator, I've undergone a lot of the schemes which of the Act, wherein there's a liability under RCM which has been imposed on e-commerce operator. Similarly, when it comes to TCS, there is another compliance which I have to fulfill. And now these penal provisions. So this is slightly, not goes with the approach which generally is being followed by the government, which essentially is ease of doing business. But one thing I would say, we'll have to agree that this is one of those sectors which effectively deals with maximum, I would say, unregistered persons. Be that cab operators, be that unregistered hotels, guest house. So some restriction, so long as payment of tax is concerned, that still, goes well. But coming to penal provision, and if you read it also, it says for any ineligible supplier. So now how would I know, being an e-commerce operator, that this person has turned ineligible? So today, when I'm taking him on board, I satisfy all the requirements, and tomorrow there may be some raid or there may be some inquiry on its part. So then, in that case, are you expecting us to check each and every time that this person is not has not defaulted, or has he crossed threshold to become a registered person, which he was like unregistered earlier? So all this will be, I would say, this doesn't go well with when it comes to e-commerce operators.
Also, I think just to add, with these kind of requirements, the government has probably gone a bit too far in imposing responsibilities on these players, because let's not forget that these platforms, create a huge market for domestic businesses, small and big. So from that perspective, it doesn't sit well. In terms of just to look back, where it all started, I think there were several cases, including one of the online travel agents when they had unlisted or unregistered hotels, and a lot of tax evasion was happening. So genuine concerns are understood, but to what extent would you decentralize your responsibility as a government to actually chase the taxpayers and just go after the big ones, so that you are actually delegating your responsibility? So extension of that delegation probably is now a bit stretched, which makes it even more difficult for newer businesses to come up. For them, supplier onboarding itself would be a huge process, and it doesn't end here, right? So I mean, tomorrow nothing stops them to just one is onboarding. The other aspect is continuously monitoring: are they compliant, not compliant, are they active, inactive? A lot of times there have been, they have, a lot of these small suppliers have registrations, they become inactive. A lot of those situations will come up. So where does it stop? That becomes a big question.
Why you are not from the e-commerce side, but at some level, supplier KYC, supplier due diligence, vendor due diligence is something that you already have to do for various other provisions of the GST law. Your thoughts on feasibility of this sort of a onerous responsibility?
So I think, to my mind, when you're shifting the responsibility to someone else, the very basic premise is that a problem, I mean, today, while this provision, they're asking an e-commerce operator to ensure that all the people, and considering the background wherein e-commerce is now one of the major, business contributors, employment contributors, and so on and so forth. I mean, I have my serious concerns in terms of, this is similar to what the GST law is also being developed at, as a recipient of service, I have to make sure that my supplier is doing the right thing. I mean, to what extent do we have to comply? I mean, someone is asking me to do the government job, in a way, right? So I personally don't agree with this, but yes, I mean, somewhere they need to put some checks and maybe some restrictions, and at the same time, as a business owner, as a recipient both, we'll do what we have to do in a normal course of business, but we cannot be expected to do so many things, for so many laws and etc. So that is what my perspective to that is.
I agree. I mean, the whole provision vis-a-vis input tax credit, where the burden has been put on the recipient, is already being litigated before multiple high courts as unreasonable, because how can a recipient ensure that a supplier, and not only L1 supplier, L2, L3, L4 supplier is complying with GST laws? That's an unfair burden. And I think this one is more in the same vein, and I would not be surprised if we see some writs being filed against this kind of a onerous responsibility. What should happen, to my mind, ideally, is there should be a list of responsibilities, a list of due diligence steps that you can prescribe on a e-commerce operator. And once that is done, no further, no liability should arise thereafter. I think that could have been a more prudent approach. I think, you have to balance the carrot and the stick. It can't be all stick all the time. So I think to that extent...
Probably just to add, when GST laws were about to come in, there was this concept that was propagated of GST compliance rating or GST rating. So if the government has all the data, they can come out with rating, and probably companies would then of course make it a part of their supplier or vendor onboarding process, that every time there is anything, they have a minimum 4-star or 5-star, whatever the rating parameters are. So I think a lot of those thoughts were there, they never crystallized.
Correct. Yeah, I think that's a very good point, that if we had the concept, if only we implemented it, I think many of these things, many of these problems would not arise.
I'll just make one more point. The other perspective on bringing these penal provisions also, maybe to discourage those vendors who are actually unregistered. That makes a responsibility even for the e-commerce operator, that they encourage those vendors or those people who are registered. So that is another way to look at things. So is it to discourage unregistered person, and whenever you're dealing with the e-commerce operator, it has to be a registered person?
No, I mean, I think what you're trying to say is that it's a move towards, or a push towards formalization, which is a good point. But I come back to the point that a policy has to be, a good policy has to be a mix of carrot and stick. We unfortunately are only going, sticks all the way. Not much carrot is coming as an incentive. I think on the settlement commission part, I have already spoken. I guess we can skip this. This is clearly unreasonable. I don't think there can be two views on this. This is one point that briefly we can talk about. And solar power sector used to be the darling of the government till about 2-3 years back. And in the last 2-3 years, with safeguard duties, with anti-dumping proposed, with BCD rate being hiked, and now project import benefit also taken away. It was taken away earlier only, now this has been confirmed by way of amendment. The point is, do we have enough capacity within India to deal with the demand? Because we are at sort of cross purposes. There is a huge amount of commitment towards renewable energy, move towards renewable energy that we have made globally. But do we have enough capacity to do it purely on the basis of domestic manufacture? I think that's the question that one needs to answer, because we are trying to completely ring fence against any sort of import-based activity in the context of solar power. Any thoughts on that? Maybe one of you, we can.
I think, as you rightly said, I mean, one is India's own renewable energy targets, and solar being the largest chunk of renewable energy in India. So this, while from a mission perspective doesn't fit well, I think what the government is trying to do is to focus on domestic manufacturing. The question is, are we ready as on date, or is it still some distance away? Be it the modules, be it the entire setup that is required. I think there is some distance to be covered. Slightly seems premature at this stage because we have already seen disruptions on power tariffs and solar power tariffs, etc., and what the industry has gone through. And even what kind of amendments and developments happen under the GST laws, from a labor and material perspective of what should be at 5% and what should be at 18%. I think with all those developments and all the journey that has happened, this at this stage doesn't seem to be in the right direction. It seems to be slightly counterintuitive.
Okay. That's what I felt also, and I mean, probably it's time that the Solar Association represents to the government, because I think they have been getting battered with many of these tax changes over the last 2-3 years. And I think this is the last point, and request all of you, maybe starting with Shrey. We have discussed some of the hits and misses, but let's talk about the omissions, things you thought would come, optimistic about, but has not materialized.
So I think for me, there were two specific things that I was personally very interested in, and I think one was on the secondment piece. Now, after the Supreme Court judgment in the northern operating systems, right? I mean, we understand the entire industry in pan-India. You would agree that everyone was clear with the Foxconn judgment. With this judgment coming in, there was a complete disruption in terms of how do you structure these transactions. But I mean, for the purpose of clarification or clarity, they would have still come out with a statement saying that post the judgment, you are still liable maybe, and for the past, we'll give you a leeway, or at least give some allowance for the interest part, right? Okay, you can claim a credit, and that credit is also something which is not very clear and can be disputed. But at least on the interest part, I would, I really wanted them to clarify. Let's see, maybe they may do it through some other mechanism. So that was one. I think the other one was the amnesty part. I think for the initial period of the GST implementation, when a lot of things were not known, and the amount of circulars, notices that have come in the recent past shows that people were not very clear, and I think some sort of an amnesty to reduce the penalties or the interest would have been really, really helpful for the industry at large. So these were the two misses to my mind.
Amnesty and clarity on northern operating. And I mean, I'm completely with you on the secondment point, the northern operating judgment. I mean, some of us would recall that when the Fiat judgment came in I think 2012 or 13, the next year budget came up with a detailed circular, because the judgment was perceived to be disastrous to the auto sector. They really narrowed down the implication or the impact of that judgment to very, very specific scenarios. So one was hoping that something like that would come up in the context of secondment, given this northern operating judgment. Siddharth, what are your thoughts on omissions?
I think a couple of points. One, from a policy perspective, is more to look at incentives. So PLI schemes, there was a lot of discussion and debate that PLI schemes for sectors like leather, textiles, electronics, a lot of those bicycles, a lot of those sectors would have some announcements. While there have been some duty tweaks around, so this does show that there is something in the pipeline, but at least there was an expectation that there would be some budget outlay announcement, and if there can be a bump up to any of the previous PLIs also, or there was another discussion around additional incentives for adoption of green technologies, because in all the PLIs that we have seen so far, there are only based on dual threshold of production and investment, nothing on sustainability. So can the government do something to also make it a vehicle to reach where it intends to in 2070? That was one. The other was, of course, around amnesty, which Shrey also mentioned from a GST standpoint, and as well as I think from a customs standpoint, it has been a long-standing wish of the industry.
Yeah, I think customs, there was a lot of expectation, a very strong expectation that something will come up in terms of amnesty, because it's been a very long while, and we have seen that happening in some of the other pre-GST taxes, service tax with Vivad se Vishwas, etc. So fingers crossed, maybe next time as the pre-election budget bonanza.
I'll put it into two baskets. One, of course, on the specific issues, like Shrey has also mentioned regarding secondment issue. There are multiple issues which are still open and which are very evident, because every time we hear that there are notices being issued on the repetitive same case. Like ISG versus cross-charge was one. Then we have the pre-deposit payments. Can we do it through my credit ledger, or I have to make it through my cash ledger? So all these issues, I'm not very sure whether budget was the right time to bring it, because they also require some discussion with the GST Council as well. So we have seen multiple clarification also coming up even in between as well. So the other side, the one was the sector, the issue specific. Other one which we were expecting something in relation to sector specific, like gaming sector. We had seen in the recent past there is a huge demand which has been raised and the issue involved whether it's a game of skill or game of chance. So those sector specific issues, and then it comes to whether GST implication will be more on the crypto side. So all these are sector specific. So that's how I put it, because there were a lot of expectation on these issues and these for these sectors, but we didn't hear much about that.
Correct. I think so amnesty, and one thing that I was really hoping was some indication of the GST appellate tribunal, budget outlay, some whisper maybe in the speech, if not in the provision or in the Finance Act, but that is rather disappointing. Crypto, of course, I mean, we have finished 1 year where income tax has laid down a very detailed framework for taxation of virtual digital assets. One was hoping that something will come up in GST vis-a-vis crypto, because while crypto, I mean, we are talking about crypto winter, NFTs have really picked up. There is a massive volume of transactions that are happening in NFT. There are a lot of even legacy FMCG companies which are looking at metaverse as a source of as one of the promotional sources, as a place where you can take promotional activities. I mean, recently GSK celebrated 50 years of Eno on metaverse, which, I mean, being such a legacy company, this was a surprise, but I think that's the message they wanted to send out, and more of such activities will happen. So one really hoped that something like that, more clarity would emerge on this. I think amnesty was spoken about, and online gaming. Well, I am fortunate or unfortunate to fight that case before Karnataka High Court, 21,000 crores. So unless that judgment comes out, the judgment reserved on that, I don't think GST Council is going to finally take a call. They have effectively given up and let the judiciary decide, then we will sort of come into play on this one. I think that's what is happening. I think, that is all from our side. We can, happy to take a couple of questions with your permission.
Great panelist. One more point is there. We are discussing about the fake invoices. So what about the invoices which seem to be overvalued? Suppose in the eyes of the government, it worth 10 lakh rupees, but invoice is 1 crore rupees. So how to handle this situation? Any provision or any penalty or any check and cross in this way? Thank you.
See, when it comes to valuation, if you are splitting an invoice or not, I don't think it will make any difference. Reason being, let's assume you have a branch wherein there is a cash outflow and you wanted to transfer some credit to one branch to another where you have a accumulated credit. So in that case, I think if you transfer a capital asset or a goods worth, assuming, continuing with your example, only 1 CR, then later on you're transferring it 10 CR. But the valuation principle has to come into play. Although you can always take an advantage of proviso, which says if your all services are all taxable or supplies are all taxable and there is no exempt supply, you can certainly take that position. Its valuation has to be accepted. But primarily when it comes to fake invoices, I don't think we'll be able to take that argument that beyond a particular limit, ideal valuation should be 1 CR. So beyond that, it's a fake invoice. So department will always come and say, "Was this particular invoice, to the extent it's for 1 CR, I am admitting it. But beyond that, because we have passed on some benefit to the other branch, which that branch was not eligible." So there is a case of fake invoice also.
Add to that, sir, thank you, sir. As you rightly pointed out, in the model law, the credit rating was promised, but it has not come so far. Similarly, in the model law, payment by credit card and debit card, it was also announced. And now when everything is going digital, this is not implemented itself. That is a very small thing, but it is not. Now I am coming to the main issue, that is the ITC credit. Recently, government has said that whatever invoices, whatever credit will reflect in the 2B, you are entitled to take. Now, and at the same time, the supplier is at liberty to file the late GSTR1. I'm not saying that he is not filing it. I'm saying that within the law. He might file after a day. He might file even in the annual return. He is allowed to file after 6 months, till 6 months. So, which is permitted by law, and it is not being the recipient. That's a very painful thing. Now, again, a situation comes, for the interstate transactions, a supplier is supplying the goods on the last date or the second last date. As per the GST law, he will file his return on at the time of supply, suppose in the month of April. The recipient gets in the month of May, and he can claim only in the month of May. Supplier has uploaded the GSTR1, maybe even invoice. Everything is compliant properly. In the May 2B, excess credit is there, but in the April is the credit, and May is shortfall, and he is penalized. So this is something ridiculous. Now, my suggestion is, Chamber should start this, input credit should be calculated in GS2B as per cumulative basis, monthly, quarterly, at best of annual. If the cumulated GSTR to be in annual fails to meet the cut, then you can take away the input. Until unless it is cumulated, even the legal requirement is giving the punishment. That's the simple solution which I am saying.
I think, so your point is well understood and absorbed from that perspective. The only thing is, unfortunately, that's how the law is. The government wants each member in the supply chain to force the other person to be compliant. That's the precise reason, and we could see that intent from the beginning, and of course how things have transpired, even when they allowed a tolerance of 20%, then 10, then 5, so it was visible that where are we headed. In terms of cash flow concerns, yes, it does.
Sir, I have said even the compliance has been done in timely. Right. Let us say the supplier has done the timely compliance in GSTR1 in the previous month, and even the second month is a problem. I am saying every party is making the compliance in time. Okay. Still the recipient is having the problem. That's a basic lock now. So my suggestion is simple, that we should force the council to make the input credit value on a cumulative basis till the annual return. If the GST are to be in the annual return fails to meet the claim, then only it should be penalized.
Hopefully, I mean, that could be one of the things that they could look at specifically on, on in-transit cases that you mentioned, because goods have to be received in physically to sort of claim that credit. So I think those situations are there, and there are enough and more transactions that happen daily. So that is something that they could look at, but the number of more exceptions they create from their perspective, the difficult it is to control, from that perspective. So they would want to keep the control systems simplistic from their perspective.
So there is one amendment in section 16 to third proviso, which says that for claiming a credit, payment has to be made to the supplier. So what is the logic of adding these words to the supplier?
So yes, third proviso has been amended to say that these two words have been added. The payment has to be made to the supplier. So one way to read it, of course, it's open for interpretation. The payment has to be made to the supplier. Assuming one example, the company is in IBC. So payment which you are making is actually to the insolvency professional. Or an example where the party or the vendor to whom you are supposed to make payment has defaulted. There is an inquiry or there is a scrutiny on its premises, and that person is not traceable. There is always a provision in the law that government can reach out to the payer that whatever payment which you are supposed to make to him, you pay it to us, because there are always a recovery proceedings against that person. So now what will happen to this situation? Will I get credit? Because there is a specific mention that the payment has to be made to the supplier. Now, because I have made payment to the government, will I be eligible to take credit? So it leaves open. We are also not very sure what was the intent behind this. But if we interpret it literally, then this is which is coming out.
So even if I make payment to the government, my liability stand discharged. So why should I be penalized for that?
That's a question. Even we are also looking for answers.
Okay. Thank you.
Sir, adding to the point of the penalization of the manufacturer, 180 to 180 days proviso has been amended, right? Earlier it says he added to the output tax liability and paid the interest accordingly, right? Now they removed that line. They said he has to pay and along with the interest. It means then contradiction is there. It means that unutilized what the accumulation credit they have, the manufacturer will not adjust that credit. They have to pay along with the interest. Interest, earlier it is also contradictory. Contradictory in the sense that interest to be paid at the time of availment of ITC credit or at the time of reversal. Because we are not paying it. From my industry I am talking about, we file the writ petition to High Court. When the changes has been come and or, if you have the accumulated credit utilized or paid, it means if you have the accumulation credit in your account, like we have more than 20 crores in our account, so there is no need to pay the interest. That is very clear, right? So in this budget, they must have to put more clarity on the points which are there. Number second, when we made the payment to the supplier, right? Earlier, 2A provision has been inserted to set that is the reconciliation for the SSC, to make the reconciliation, right? Now they said that what is appearing in 2A you have to avail, otherwise not appearing in 2A you have to reverse 2A or 2B, right? So the provision when I made the payment to the supplier, the payment has been already made. The sir said that compliances he has done next month. I am saying he has not paid the tax, right? And not filed the return. So why the manufacturer has been penalized that you are not able to avail the ITC when I already made the payment to the supplier? Second point is there. First point is ITC part. Number second, many places the tribunal has not been constituted. I have several cases in the state where I have already done the VAT assessment, everything has been done. Only the refund of the amount, the tax amount has to be come to me, which is in lakhs and crores. The authority says, sir, this is the VAT issue. The tribunal has not been constituted till date. So we can't approach to the High Court directly. So this, for my sense, what I am saying is this clarification should come in this budget also, so that the SSC should not be suffering. That real taxpayer SSC, which we are having, will not suffer.
I think all completely valid points, and these are points that have been reiterated over 5 years. Unfortunately, some amount of relief has come from high courts wherever people have approached high courts. But the institutional response, so to say, unfortunately is still lacking, and one hopes that it comes. I mean, I don't think I have any further clarification to add on that. But yeah, I mean, these points we as ASSOCHAM have also raised several times to the authorities. Incrementally, some of these have been attempted to be addressed, but yeah, not holistically. On the point of tribunal, see, most people are approaching high courts, and except for maybe Allahabad, mostly high courts have been accommodated. Because see, if crores of refund is pending, I can't be denuded of my right of appeal just because a tribunal has not been set up. And there is no line of sight, there is no budget allocation even in this budget for tribunal. So beyond a point, my right, my access to justice cannot be denied. And I frankly have seen high courts really coming into, coming in and helping out SSCs, except for one or two, stray cases. So to my mind, writ is a valid and viable option if you are stuck.
Sir, one point also I stuck and fighting for last 3 years. I will give you a simple example. I have exported the goods. I am from Jindal Steel, right? So we have the agreement with our customer that any inflation of price of steel, they will reimburse the amount to us, right? So what happened, in 100 rupees I sell the good, right? I exported the goods, and there is a transaction, there is also agreement with the customer that, that within the period of 4 or 5 months, when he is utilizing my product, he will reimburse that amount. What is the actual rate of the steel at that time, right? So I exported the goods, suppose I exported the goods in the month of January, right? After next month filing or return, automatically there is a ICE gate, automatically I get the refund of that part also. During that time I have made the on payment of duty, because I have the accumulated credit in my books. So I made the export on payment of duty and utilized that credit. I got the refund also, right? After 4 months, 3 months, I got some escalation of price. Suppose 10 rupees I got it. Then what happened? Government demanded 10 rupees you have to pay the duty. What about the refund mechanism? There is no manual refund mechanism. If I pay the duty on 10 rupees. Vice versa, if I made the exports on LUT, then I asked, many times I went on the hearing, policy wing also, I asked, suppose, if I will not pay the duty at that time, then what is that part? So the government says, we will not demand on LUT part. But as you made the exports on payment of duty, then we are demanding on payment of duty part. So what about the refund mechanism? No clarification has been come at yet. 3 years I am fighting. For this I filed the writ petition in Haryana, in Chandigarh also, in the High Court also. But they have written the letter to the Commissionerate asking the clarification, and the Commissionerate has forwarded a letter to Policy Wing. But even then, I have recently met last week to the Policy Wing, to the officer, and they said we are doing it, but no reply has been completed. I am unable to get the stay till date.
I mean, this is a very specific fact scenario. Speaking in generalities, when I say the High Court sort of comes in, I mean, we can pass on, I think, through ASSOCHAM some of these grievances. Any other question, or we can wrap up?
But my request is to pass on this, so that from our side, anything relief can be get it accordingly, right? So that it can be addressed properly. But that's all, from the industry perspective. Thank you.
Hi. This will be the last question. I think we are way past time. So, thin line between hunger and anger, and I don't want to cross that.
So what's the relevance of putting this time restriction to file the return maximum within 3 years when we already have the provision of cancellation of the registration when the SSC do not file the return for 3 months or 6 months? What's the relevance of putting this time restriction of 3 years? Is there any relevance of it?
So it appears to be the case where there is a cancellation of registration, which is kind of a suo motu cancellation. And later on, let's say that has been challenged and High Court gives you a relief in that case. So you should have an enabling provision that allows you to file a return. So that's how the timelines can come. And not only timelines, if you'll see there is another amendment which says the government is also empowered to grant you relaxation in terms of filing of a return at that point in time. So that's what we correlate to, because there are a lot of cases we have seen. There is a judgment from the High Court saying that this will not be just. So therefore, you have an opportunity, file your return, it can't be said cancelled. So then in that case, because the system has already cancelled my registration, so I should have an enabling provision that you can allow me to file my returns even after that cancellation. So that's how it works.
So are these enabling provisions or restrictive provisions?
So I would say it's a restricting to say you cannot file it beyond 3 years, but so far as enabling provision is concerned, so you need not to approach High Court all the time, and then you can sort it out at your jurisdiction level also. So that's how we see it.
Thank you.
But there are no time limits for tax payments, so you can.
Yeah, that can be made always. Correct. Thank you.
Big round of applause for all our speakers on stage. Thank you so much for taking us through the details of the provision and patiently answering all the questions. A big round of applause for all of them, and thank you so much. With this, we come to the end of the special post-budget conference on the analysis of tax-related proposals brought to you by ASSOCHAM. I hope it's been an insightful session today and a lot of your doubts have been clarified. We are grateful to all our speakers for taking the time out and coming here today. We would like to thank our sponsors for their support, our Presidium partners RenewPower, SpiceJet and TCI, and our Platinum partners BDO, Grant Thornton, Nangi Anderson, and PwC, and our gold partners, Economic Law Practice and Khaitan & Co. Thank you all for joining us. Please join us for lunch.